Hello, my dear students. Welcome back, everybody. Hope you guys are all doing good. Hope you are all perfectly fine. So, in this video, we'll be revising the standards on auditing chapter. So, as you all are aware, this standards on auditing chapter is such an important chapter where a significant amount of weightage will be there in your examination, and conceptually also it is going to be very important. So that is what going to be the agenda for this video. So we will be doing one quick and perfect revision of the standards on auditing. So first, let me put before you what are the standards which I am going to revise in this particular chapter. So there are 10 standards which are forming part of this chapter. So if you see the index here in the material, see, as we all are aware, the entire syllabus of CA Inter has been taken from standards. If not entire syllabus, so minimum 80% of syllabus, whatever we are reading in the CA Inter auditing and assurance, 80% of the syllabus has been taken from standards only. The remaining 20% of the syllabus has been taken from laws and regulations and other practical concepts. Like, if I say, when we discuss the chapter nature, objective and scope of audit, so that nature, objective and scope of audit is in fact taken from two standards, SA 200 and SA 210. When I say I will teach you audit reporting chapter, there also I will teach you some standards on auditing only, like 700 series of standards, SA 700, 701, 705, 706. So like this, whatever chapters which are there as a part of our curriculum, those chapters are actually taken from standards only. But there are some 10 standards which are not covered in any other chapter, which we need to have a exclusive discussion. How many standards are there which are not covered anywhere else in any other chapter? So there are some 10 standards on auditing which will not be covered as a part of any other chapter, which we need to have a dedicated discussion. So those are 10 standards which need a dedicated discussion, which will not be covered in any other chapter. Those 10 standards are forming part of this particular chapter, standards on auditing. And what are that 10 standards which are not covered anywhere else in this anywhere else in any other chapter? That list I have given here: SA 220, SA 250, SA 501, 505, 510, 550, 560, 570, 580 and 710. So these are the 10 standards which will not be covered anywhere else, which we need to have a exclusive discussion, exclusive revision here. So these are the 10 standards which I am going to revise. Very important concepts from the examination perspective. You can expect a minimum of 10 marks, and if a case scenario based MCQ gets tested, you can easily score some 15 marks out of this 10 standards revision. So I will try to cover all the key concepts within the limited time available, and also I will make sure that we are not leaving out any significant things from this particular revision. So without any delay further, let us directly jump into the discussion. Let us directly jump into the revision part. So first I will start with SA 250. First we will revise SA 250. And one more thing before I take up any discussion further. So if you want to download the material which I am displaying here, so please check the description below, or description for this video. There I have given detailed instruction how you can download and how you can get access to this material, which is completely free. So if you want to have access to this material which I am displaying you here on the screen, so check the description below, or check the description of this video once. So now let us, without any delay further, let us directly come to our discussion. So first we'll be revising SA 250, which is about consideration of laws and regulations in audit of financial statements. And one more thing, before we go into discussion of these standards, I want to do one quick revision of standard setting process, how the standards will be set. So this discussion is very important for MCQs. For MCQs and true or false statements, this discussion might be very important. So first I will revise the standard setting process. So actually the standards on audit are the thing which we follow in our country, but the content of the standards on auditing has been adopted from something called international standards on auditing. At India level, we have something called standards on auditing, and the content has been adopted from international standards on auditing. Now, first, who will issue this international standards on auditing? So we have an association called IFAC, International Federation for Accountants. It is a global association. So there is a IFAC, International Federation for Accountants, and this IFAC has created a board called AASB, Auditing and Assurance, IAASB, sorry, International Auditing and Assurance Standards Board. And this IAASB will issue high quality standards called ISA, International Standards on Auditing, which are applied, which will be accepted across the world. So these are international standards. IFAC has created IAASB, and that IAASB, under this guidance of IFAC, they will release something called International Standards on Audit. This is at the global level. Now, talking about at the India level, the role of IFAC will be played by ICAI, Institute of Chartered Accountants of India, and they have created something called AASB, Auditing and Assurance Standards Board. And this AASB will issue standards on auditing, which we follow in India, which are actually adopted from international standards on auditing. And the numbering also will be same, the standards numbering will be same, the content of the standards also will be same, almost the same. 95% of the content is same. Why? Because across the world, wherever you do the auditing, auditing will not change. Wherever in the world you do the audit function remains the same, independent examination of financial information. So even numbering is also same. We have SA 200, overall objectives of an independent auditor and conduct of an audit in accordance with the standards. Similarly, we have ISA 200 with the same title, with the same content. We have at India level SA 230 audit documentation. At the international level, we have ISA 230, once again audit documentation. So this is what the standard setting process. This is how the standards will be set. So that's what will be the introductory discussion here. So IFAC has been created. This IFAC is working with the objective of bringing harmony in accounting and auditing profession, not just in one country, at an international level. And they will issue high quality standards, and by creating International Auditing and Assurance Standards Board, which is IAASB, and their objectives are given here. And at our India level, the role of IFAC will be played by ICAI, and they have created something called AASB, and they are giving this standards on auditing in our country. And talking more about this functions of ICAI, whatever documents which are released by ICAI, they will fall under two categories. One is statements and the other one is guidance notes. Whatever documents which are released by ICAI, they fall under two broad categories. One is statements, other one is guidance note. The differentiating factor between the two is statements are something whose compliance is mandatory in nature. Statements are those documents which are released by the institute whose compliance is what? Mandatory. They are to be compulsorily followed. Whereas guidance notes covers those documents whose compliance is recommendatory in nature. Whose compliance is what? Recommendatory. They are not hard and fast rules which everybody should follow. They are just what? Recommendatory in nature. So when I say recommendatory, here there is one thing which we need to be very focused, which is very important for true or false statements. Sometimes they might ask you a question: guidance notes are recommendatory in nature. All guidance notes are recommendatory in nature. If they ask you this kind of question, the true or false statements, you have to write the answer as false. So just now you told guidance notes are recommendatory, but guidance notes are generally recommendatory in nature, except a few guidance notes which are mandatory. The general nature is what? Recommendatory. But there are some two guidance notes whose compliance is what? Mandatory in nature. So that's why if they ask you the question in the exam as a true or false statements, all guidance notes are recommendatory. What should be your answer? The answer should be false. Generally, guidance notes are recommendatory in nature, except a few guidance notes whose compliance is what? Mandatory. So that's how the documents given by ICAI will be divided. One is statements whose compliance is mandatory, and other one is guidance notes whose compliance is recommendatory in nature. Now, standards will fall under which category? Statements or guidance notes? Standards will fall under statements category. Why? Because compliance of standards is mandatory in nature, not recommendatory. So standards will fall under statements category. Now, coming to the standards, in the standards also, there are different kinds of standards relating to auditing work which ICAI has released. So what are the different kinds of standards which are given by ICAI? So this chart has been given here, but let me try to summarize quickly. So there are four kinds of documents which are given by ICAI, that to standards category. One is SA, standards on auditing. Other one is SRE, standards on review engagements. Other one is SAE, standards on assurance engagements. And finally SRS, standards on related services. So how many are there? 4 are there. What are they? Standards on auditing, standards on review engagements, standards on assurance engagements, standards on related services. Now it is very important for us to understand what does this each kind of standard deal about. What do you mean by audit engagement? What do you mean by review engagement? What do you mean by assurance engagement? What do you mean by related services? Talking about standards on auditing, they become applicable whenever audit of historical financial information is conducted. Being an auditor, if someone appoints us to do the assignment, to do the engagement of audit, that too of historical financial information, then standards on auditing we have to comply with. So standards on audit will become applicable when we are associated with engagements of audit, that too of historical financial information. Now talking about SREs, standards on review engagements will become applicable whenever we are associated with review of historical financial information. Which engagement? Review. Now, what is the difference between audit versus review? So, what is the difference between audit versus review? Audit is a reasonable assurance engagement, which we all know, whereas review is a limited assurance engagement. One new terminology. Audit is a what kind of engagement? Reasonable assurance, whereas review is a what? Limited assurance engagement. As we know, reasonable assurance is a high level of assurance, but not absolute assurance. Now, review is even far lesser than reasonable assurance. In review assignment, we don't even get reasonable assurance also. We get only limited assurance. Like for example, if I have to give you one example of review engagement, I will say quarterly financial statements of listed companies will be verified by the auditor, but that verification we don't call it as audit, that verification we call it as review. Why? Because there the scope of auditor's verification is very limited. He will not even check the supporting documents also. He will check whether quarterly financial statements are presented properly or not. That's it. So whenever you are doing assignments like review of historical financial information, then SREs will become applicable. Assurance will become applicable. SAs will become applicable when you are doing assignments, when you are associated with other than historical financial information. When you are doing some work which is related to not historical financial information, which is related to prospective financial information, future financial information. Sometimes as an auditor, we might be required to deal with future financial information, prospective financial information of the company. So whenever you are doing some work which is not related to historical financial information, but in fact related to future financial information, then SAEs will become applicable. Whereas SRS, standards on related services, they become applicable when we are providing related services, or alternatively we can call it as when we are providing agreed upon procedures. When we are providing what? Agreed upon procedures. Being a chartered accountant, we need not always do only verification checking work. Sometimes we perform agreed upon procedures also, like preparing financial statements of the company, etc. So when you are providing related services other than verification work, when you are performing agreed upon procedures, then which standards become applicable? SRS will become applicable. So like these 4 kinds of standards are given by ICAI. Everything will become applicable depending on the engagement which you are doing. And all these 4 standards will be collectively called as engagement standards. So when they say engagement standards, what and all they are referring to? Engagement standards include SAs, SREs, SAEs, SRS. So collectively all the 4 will be called as what? Engagement standards. Now whenever any of this engagement is performed, be it audit, be it review, be it assurance, be it related services, one more kind of standards will be applicable, which we call it as SQC. What do we call it? SQC. What is the meaning of that? Standards on quality control. And they become applicable when you are doing any of the above engagement, be it audit engagement, be it review engagement, be it assurance engagement, be it related services. Whenever you are doing any of the above 4 engagements, one more series of standards will become applicable, which is what? SQC, standards on quality control. Now what is the purpose of SQC? So they ensure quality in the engagements whatever auditor is doing. Any audit engagement, any review engagement, any assurance engagement, whatever you are doing, there is a requirement to maintain the quality in that engagements. So SQC will help the auditor to ensure the quality in the audit engagements or any other kind of engagement. So these are different kinds of standards given by ICA: SAs, SREs, SAEs, SRS and SQC, and each one will become applicable depending on the kind of engagement which you will be doing. So this is what key information regarding standard setting process. This information might not be that relevant for descriptive questions, but this is highly important for answering MCQs and true or false statements. So this is what the standard setting process. Now let us try to start discussing the standards itself. So we will start with now SA 250. Let us go to it. So SA 250, as you could see, the title of the standard: consideration of laws and regulations in an audit of financial statements. So as the title itself says, SA 250 is going to talk about laws and regulations while you are conducting audit of the financial statements of the client. So as we all know, as a part of audit, sometimes we are required to check the statutory compliances also. What we even need to check, statutory compliances also we need to check. Like for example, whether your client is complying with all the laws and regulations or not, that also will form part of one of the scope of the auditor. So now this standard is going to explain in detail what will be auditor's responsibilities regarding laws and regulations while conducting audit of the financial statements. Now, which laws and regulations this standard is talking about? Is this standard talking about those laws and regulations which is auditor's responsibility to comply, or is it talking about those laws and regulations which is management's responsibility to comply? So this standard is talking about those laws and regulations which your client's management has to comply with. Like for example, if you are conducting audit of some company, assume Reliance Industries Limited. As we all are aware, when any business is being run, they need to do the business after complying with so many laws and regulations. Yes or no? So that is what the laws and regulations we are referring to. So this particular standard is talking about the auditor's responsibilities relating to laws and regulations which your client has to comply with. Which who has to comply with? Your client has to comply with. So now let us go into the technicalities of the standard. Let me ask you one simple question first. It is whose primary responsibility to comply with the laws and regulations? If you are conducting audit of the company Reliance Industries Limited, who is primarily responsible to make sure that the company is complying with all the laws and regulations? It is not auditor's responsibility. It is not auditor's primary responsibility. It is always the primary responsibility of the management of your client to make sure that their entity is complying with all the laws and regulations, and to identify any non-compliances. These primary responsibility always and always rest with management. So point number one, the primary responsibility to comply with all the laws and regulations is with management. So now what about auditor's responsibility, sir? Let us come to the point now. So can you expect auditor to prevent all non-compliances? If you are appointed as auditor of a company, can the shareholders or can the management expect the auditor to make sure that the client company is complying with all the laws and regulations? Can they make sure? No. So auditor cannot be expected to prevent the non-compliances. Very good. Can the auditor be expected to detect all non-compliances? No. So auditor cannot be expected to prevent the non-compliances. At the same time, auditor cannot be expected to detect all non-compliances. So does that mean auditor will not be held responsible at all if it didn't find non-compliances? No. Then what about auditor's responsibility, sir? For that only we are reading this standard. That is what the objective of this standard. Clear what I'm trying to say? So auditor is not responsible for preventing all non-compliances. He is not even responsible for detecting all non-compliances. Then what is auditor's responsibility, sir? That's what this standard is going to talk about. So now what does this standard say about auditor's responsibility? So what this standard has done is, for the purpose of discussing auditor's responsibility, the standard has divided laws and regulations into two categories: type 1 laws and regulations and type 2 laws and regulations. For the purpose of auditor's responsibilities, this standard has divided laws and regulations into two categories: type 1 laws and regulations and type 2 laws and regulations. Type 1 laws and regulations are those laws and regulations which have a direct effect on determination of amounts and disclosures in the financial statements. Which laws will come under type 1? Those laws and regulations which have a direct effect, which are going to directly impact the amounts and disclosures in the financial statements, they will come under type 1. Sir, any examples for this kind of type 1 laws and regulations? Yes, there are plenty. If you ask me, Companies Act 2013. Companies Act 2013 is going to have a direct impact on determination of amounts and disclosures in the financial statements. If the company is preparing financial statement, which format they follow? Schedule 3. Where Schedule 3 was mentioned? Companies Act. So Companies Act is going to have a direct impact on determination and amounts of financial statements. Next, not just that, Income Tax Act, tax provision which you calculate, from where the tax provision will be calculated as per the provisions of Income Tax Act. And also employee benefit related laws and regulations like gratuity, bonus, PF. So like that, those laws and regulations which have a direct effect on determination of amounts and disclosures in the financial statements will come under type 1 laws and regulations. Now what about type 2 laws and regulations? So type 2 laws and regulations are those laws and regulations which do not have direct effect on determination of amounts and disclosures. They are not going to directly affect the amounts and disclosures, but compliance is required. Even though they don't have any direct effect on determination of amounts and disclosures, but compliance with these laws is also required. Why compliance is required, sir? Either to avoid penalties. If you want to avoid penalties, you have to comply with this law. Or these laws are so fundamental to continue business. So what will come under type 2 laws and regulations? Like as we could see in the standards content itself, other laws and regulations that do not have direct effect on determination of amounts and disclosures, but compliance is required because they might be fundamental to continue the business. Or if you want to avoid major penalties, you need to comply with them, even though they don't have direct effect on determination of amounts and disclosures. Sir, any examples for this? Yes, here also there are plenty. Like let me give you example of pollution related laws and regulations. Assume you are a manufacturing entity. If you don't comply with pollution related laws and regulations, what will happen? Either you are supposed to pay a major amount of penalty, or sometimes the government authorities will come and seal your premises. So this pollution law is not having direct effect on determination of amounts and disclosures. But if you don't comply with them, what will happen? Either you might be required to close your business, or you have to pay huge amount of penalties. Or environmental related laws and regulations, or child labor related laws and regulations. So those kind of laws and regulations will come under type 2. Understood? So for the purpose of auditor's responsibilities, this standard has divided laws and regulations into two categories: type 1, type 2. Type 1 which have direct effect on financial statements, type 2 which do not have direct effect but compliance is required if you want to avoid penalties, or these are fundamental to continue your business. Now what is auditor's responsibilities regarding type 1 laws and regulations? The standard says regarding type 1 laws and regulations, the auditor's responsibility is to obtain sufficient and appropriate audit evidence. What is auditor's responsibility regarding type 1 laws and regulations? To obtain sufficient and appropriate audit evidence, to perform in-depth audit procedures, treat it like any other item of financial statement, perform in-depth audit procedures, and try to obtain sufficient and appropriate audit evidence regarding their compliance. Whereas when it comes to type 2 laws and regulations, here auditor's responsibility, the standard says perform only limited audit procedures or specific audit procedures, anything you can say. So when it comes to type 2 laws and regulations, you need to perform only limited audit procedures or specific audit procedures. Sir, what are the specific audit procedures or limited audit procedures, sir? That is mentioned in the same standard itself. So standard is saying for type 1, perform in-depth audit procedures. For type 2, perform limited audit procedures or specific audit procedures. Sir, what are that specific or limited audit procedures? That is given in the standard itself. So what are that specific audit procedures for type 2 laws and regulations? Sometimes they might ask you in the question, what are specific audit procedures for other laws and regulations? So the point which I want to make here is, even if they ask you type 2 laws and regulations, or even if they ask you other laws and regulations, both convey same meaning. Other laws and regulations or type 2, both convey same meaning. So what are the specific audit procedures for type 2 laws and regulations? See here, specific audit procedures are very simple. Only 3 things they will say. That is also inquiry only. Number 1, you have to inquire with management and where appropriate, those charged with governance. Like you want to know whether company has complied with pollution related laws and regulations. Since it is a type 2, you need to perform only limited audit procedures. So what is the first limited audit procedure? Go to the management and those charged with governance and inquire with them. So did you comply with all the type 2 laws and regulations, or did you make any non-compliance? Inquire. Second one, inspecting correspondence, if any, with licensing or regulatory authorities. Nothing but check whether any notices has been received from regulatory authorities, like any pollution department sent you notice. So like that, check whether any correspondence, whether any communication is happening from licensing or regulatory authority. If there is any in-house legal counsel, if the company is having internal legal department inside their company, go and inquire with entities in-house legal counsel. So if you want to, regarding type 2 laws and regulations, you need to perform only 3 limited audit procedures or specific audit procedures. What are they? One is inquiry with the management, check any communication happened with the licensing or regulatory authorities, and also inquire with entities in-house legal counsel. Whatever internal legal department is there, whatever internal legal team is there, go and inquire with them. That's all. Your responsibility is over. Regarding what? Type 2. But when it comes to type 1, auditor has to treat it like any other ordinary item of financial statements and perform in-depth audit procedures. Clear? Half of the standard we have revised. So that's what the objective of the standard. If you read the objective of the standard, number 1, to obtain sufficient and appropriate audit evidence regarding those laws and regulations which have a direct effect, nothing but type 1. To perform specified audit procedures regarding type 2 laws and regulations, nothing but other laws and regulations. And whatever your findings are there, you have to report them. You have to respond appropriately to non-compliance. If you find any non-compliances with either type 1 or type 2 laws and regulations, you need to respond appropriately. Sir, how to respond appropriately? How to report them appropriately? Before we talk about reporting them appropriately, you need to know the definition of, sir, what is non-compliance? What is non-compliance? I will simply say not following laws and regulations, we call it as non-compliance. But technically they have given definition. How the term non-compliance has been defined? Act of omission or commission. You are not doing something, or you are doing something, act of omission or act of commission, either intentional or unintentional. Either you are doing it intentionally or unintentionally, which are contrary to prevailing laws and regulations. Very simple. You are not doing something, or you are doing something, either intentionally you are doing or not doing, or unintentionally you are doing or not doing. And whatever you are doing or not doing, that is against to laws and regulations. If you do something or if you don't do something as per laws and regulations, that we call it as non-compliance. And when I say entity made a non-compliance, company made a non-compliance, what do you mean by company making a non-compliance? How can company make non-compliance? A company's building, will it go and do non-compliance? No. Company making non-compliance means in the name of the company, either management, employees, those charged with governance, they are entering into transactions on behalf of the company. That is what we call it as a non-compliance made by company. Clear, everybody? So this is what the meaning of non-compliance. Now let us come to the most important part, reporting requirements. As an auditor, if you find any non-compliance, to whom you have to report, how you have to report. First thing, you have to report the non-compliance to those charged with governance. You have to report non-compliance with whom first? Those charged with governance, top level management. So if you believe that as an auditor, if you believe there is a non-compliance with the laws and regulations, first you have to communicate the matter with those charged with governance as soon as practicable. If you came to know about any non-compliance, first immediately go and report with those charged with governance. See, if low-level employees committed non-compliance, if you report it to top-level management, then it will be of some purpose. What if top-level management themselves are involved in the non-compliance? What if the top level management themselves did the non-compliance? Then what you should do? Let us see what they are saying. If the auditor suspects that management or those charged with governance themselves are involved in the non-compliance, then the auditor shall communicate the matter to next higher level of authority. If you came to know the management itself committed non-compliance, determine whether any next higher level of authority is there. If exists, generally it will not exist. Why? Because beyond those charged with governance, there will be no top level management. If you find any, report it to next higher level of management. Sir, what if no higher authority exists? Or I am confused, sir, I don't know whom to report this matter. Why? Because top level management themselves are involved. Then the standard says you have to obtain the legal advice. What the standard will say? Obtain legal advice. Very simple, guys. You have to report to those charged with governance. But if you came to know the top level management themselves are involved in the non-compliance, then what you should do? Determine whether any next higher level of authority is there. If it exists, report to them. What if there is no higher authority, or if the auditor is confused to whom to report? Then what he will do? He will need to obtain legal advice. You have to go and consult some legal expert like a lawyer. He will let you know what to do. In addition to communicating with those charged with governance, you need to even consider modifying your opinion in the auditor's report. So how it will impact my opinion? Let us try to summarize it in the form of a chart. So impact on auditors reporting. So here the standard has divided into two circumstances. When you obtain sufficient and appropriate audit evidence and concluded that there is a non-compliance. Concluded there is non-compliance. You have obtained audit evidence, and on the basis of that evidence, you came to know that yes, company has not complied with some laws and regulations. Now, the auditor need to check one thing, whether adequate disclosure given in financial statements, no disclosure given in financial statements. If the management did some non-compliance and they gave proper disclosure in the financial statements, they did not hide anything from the shareholder. They have clearly told these and these laws we have not complied, this much penalty we have paid. Management did not hide anything. Clearly they have given disclosure in the financial statements. The standard says give unmodified opinion only. Give what? Unmodified opinion only. Whereas if you came to know that the company has made some non-compliance, but management hidden it in the financial statements, management did not disclose this to anybody. Now tell me, financial statements are containing a misstatement or not containing a misstatement? Obviously financial statements are containing a misstatement. They are misleading. Management did not disclose. They have hidden it. Now what the standard says is, if there is no disclosure given, directly give the modified opinion. And which kind of modified opinion, sir? Since it is a case of availability of audit evidence, you have to give either a qualified opinion or adverse opinion. Why? Because I told auditor is having evidence. The other case which could be possible is auditor unable to obtain audit evidence. Auditor unable to obtain audit evidence, is not in a position to get the evidence to conclude whether laws and regulations are complied or not. He was unable to get evidence. Now what he should do, sir? Now the standard will directly say give the modified opinion. Now which kind of modified opinion, sir? Which kind of modified opinion? Disclaimer. Not only disclaimer, you have to give either qualified or disclaimer. If the possible effect of that non-compliance is only material, I will give qualified. If the possible effect of that non-compliance is material and also pervasive, I will give disclaimer. Here also, when I have evidence and I concluded that non-compliance is there, the effect is only material, qualified. If I know that effect of non-compliance is material and pervasive and I have evidence, I will give adverse. Clear? So in addition to reporting to those charged with governance, in this manner, you need to consider the impact on opinion also. Finally, in addition to that, determine is there any requirement on you to report the non-compliances to regulatory and enforcement authorities. Like in case if you are conducting audit of a bank, in addition to reporting to those charged with governance, in addition to mentioning that in your auditor's report, you even need to communicate this matter to RBI. So determine whether there is any reporting requirements on you to report that matter to regulatory and enforcement authorities like RBI, etc. So this is what the reporting requirements. Now the standard has given one more information. They have given you some indications, some events which give a hint to the auditor that there could be non-compliance. These are not something that compulsory. If you find these indicators, that doesn't mean compulsorily there is a non-compliance. These are just what indicators which give a hint to the auditor. Boss, these kind of things have happened. Please be aware. There could be non-compliance. Nothing but auditor should become more aware when he comes across these indicators. What are they? Investigation. Recently, some regulatory authority or government authority came and did the investigation. That is a clear thing, that is a clear factor which is giving hint to the auditor that there could be non-compliance. Or the company is making payments for unspecified services to the consultants like lawyers, related parties, government employees, etc. Or the company is able to purchase the products at significantly higher or below the market price. When each and every of your competitor is paying a certain price, you are either procuring it at very lesser price, or you are procuring it at a very higher price. Indicator of non-compliance. Unusual payments in cash, huge cash payments, or unusual payment towards legal and retainership fees. The client is paying huge amount of fees to the lawyers. Unusual transactions with companies registered in tax havens. The company is having transactions in the tax havens. Recent case, Adani. This is what happening in the Adani. So in the Hindenburg report, they have told that Adani is having transactions with the tax havens like Mauritius. They have some 30 companies incorporated in Mauritius. These are the allegations made. So if your client is having transactions in the tax havens, tax-free jurisdictions like Mauritius, that is also indicator of non-compliance. And payments without proper documentation, no supporting documents are there for the payments, unauthorized transactions, improperly recorded transactions, or some bad news is circulating in the media regarding your client company. So if you come across any of these indicators, you should become extra aware that there could be a possibility of non-compliance, and become cautious and do the audit. This is what SA 250 is talking about. So successfully we are done with revising the standard SA 250. Now let us start revising the next most important standard. I will give it a top priority. Out of the 10 standards, I will give it a top priority when it comes to importance from the examination perspective. So the standard which we will be revising now is SA 501. So what does this SA 501 deal about? So as you could see, SA 501 is a standard which is talking about audit evidence. But you all might get a doubt. So we already have a dedicated standard talking about audit evidence, which is SA 500. So SA 500 is a dedicated standard talking about audit evidence. Now I am saying SA 501 is also a standard talking about audit evidence. What is the difference between the two? The difference is SA 500 is a general standard talking about overall audit evidence in general. SA 501 is a standard talking about audit evidence, and it is providing guidance to obtain audit evidence regarding 3 selected items. Special standard, I will say. So SA 500 is a general standard talking about overall audit evidence in general, whereas SA 501 is a specific standard talking about audit evidence only, but it provides guidance only regarding 3 selected items. Sir, what are that 3 items regarding which SA 501 is giving guidance? So as you could see the objective here, the objective of the auditor is to obtain sufficient appropriate audit evidence. But regarding what? Regarding 3 things: existence and condition of inventory, completeness of litigations and claims involving the entity, and presentation and disclosure of segment information. So 3 items which SA 501 is talking about is inventory, litigations and claims, then segment information. So let us try to understand, let us try to revise now how to obtain evidence regarding existence and condition of inventory, how to obtain evidence regarding litigations and claims, how to obtain evidence regarding segment information, and what SA 501 provides the guidance here. So first we will start with existence and condition of inventory. How you can obtain audit evidence regarding inventory. As we all know, inventory is a significant item in the financial statements. So how you will come to know whether the inventory value stated there is correct or not. How you can get to know about it. How you will obtain audit evidence. So the standard also says whatever common sense we have. So if you are an auditor, tell me out of your common sense, if you want to know whether inventory is correct or not, what you will do? What I will do? I will try to do physical verification. That's what even the standard says. The auditor should try to obtain evidence regarding existence and condition of inventory by doing physical verification, not directly doing, by attending the physical verification whenever it is done by the management. So management will be responsible for doing physical verification of the stock. They will do it once in every year. Most of the companies will do it also on the balance sheet date. So whenever management is doing the physical verification of their stock, auditors should go and attend that physical verification. That is the first step. Whenever the management is conducting physical verification, they will let the auditor know about it. Auditor should go and attend that physical verification process. What he should do by attending there, sir? See what they are saying. So you have to attend at physical inventory counting to and evaluate what are the management's instructions and procedures for doing that physical verification. First sit and analyze, first sit and understand what instructions, what procedures management is following for doing that physical verification. Then sit and observe whether they are doing the counting properly or not, whether they are doing that physical verification properly or not. Sit and observe. And also, if you are feeling bored by sitting there continuously, you go and inspect the quality of the stock. And even if you are feeling more bored, go and do the test counts also. Nothing but on sampling basis, you also try to count some inventory. And finally, check as a part of that physical verification whether they match with the quantity as in the books of accounts. That's what the main purpose of physical verification. No, we do it to know whatever stock that is lying there physically at the warehouse, whatever stock that is lying there in the books, both are matching or not. Find it out. That's what the first step. So auditor should obtain audit evidence regarding existence and condition of inventory by attending inventory counting process done by management, and by attending there, evaluate, understand what are management's instructions and procedures, observe how they are counting, inspect the quality of inventory, and you also perform some test counts. Next one. And even check whether the stock is matching with the books or not. Sometimes what will happen is the management will do physical verification, but not as on the balance sheet date. They will do it at a date other than the date of the balance sheet. Most of the companies will do it as on balance sheet date, but some clients might do the physical verification on other than balance sheet date. Assume that your client company is doing verification as on 5th of April, other than balance sheet date, after 5 days from the balance sheet date. Then also you have to attend. But after attending there, just doing the above 4 things alone will not be enough. Even you need to check whatever transactions that have happened from the balance sheet date, that is from 31st of March till 5th of April, whatever additions, deletions are there to the stock, that also needs to be verified. Why? Because the client is verifying stock on 5th of April, and if the stock as on 5th of April is matching with the books, that alone will not be enough. Why? Because stock on 5th of April will not come in the financial statements. Stock on 31st of March will come in the financial statements. Now, how to calculate the stock as on 31st of March? By doing reverse calculation. How to do reverse calculation? So how to do that reverse calculation? You take the stock on the date of verification on 5th of April. This is the stock available. Add back all the sales which have happened from 1st of April till 5th of April. That you have to add it back. Sales or consumptions, whatever it is. Now you have to reduce purchases or additions, whatever have taken place from 1st of April till 5th of April. That you have to, this you have to add it back, sales and consumption, and purchase you have to deduct it. Now whatever balancing figure that you get, that will be the stock available as on 31st of March. Nothing but we are doing reverse calculation. So if inventory counting is happening on other than balance sheet date, check whatever transactions that have happened between the date of financial statements and the date of counting, whether they are really genuine or not. This is very important if stock verification is happening on other than balance sheet date. Now, sometimes what will happen is management will call you for physical verification, but you are unable to attend it because of unavoidable circumstances. Might be you're out of town, or you are busy with other assignments, or you are sick. None of your engagement team members are available. So whatever may be the reason, management has done the physical verification. They even invited the auditor, but auditor was unable to attend. Then what should happen? So then what should happen is, let us see what the standard says. If the auditor is unable to attend physical inventory counting by the management due to unforeseen circumstances, the auditor shall make or observe some physical counts as on some alternative date. Very simple. If you are not going and attending inventory counting done by management on some alternative date, you have to go to physical verification on your own and do some random counts and do some sample counting on along with your engagement team. If you go when the management is doing physical verification, you can just sit and observe. If you did not attend the management's inventory counting, then you have to take your team on some alternative date, go and do the verification on your own. Clear? That's what should happen. So first step, you have to attend management's inventory counting. If not possible, you do physical verification on your own if you are unable to attend management's inventory counting. See, sometimes, and when you go for physical verification on your own, what are the things which you need to pay attention? You need to pay attention to the factors like the nature of inventory. What is the nature of inventory? How much is in the form of work in progress? How much is in the form of raw material? How much is in the form of finished goods? Even when it comes to work in progress, pay attention to stages of completion. Work in progress, is it 50% completed, 60% completed, 70% completed? Why? Because depending on percentage of completion only, cost will be allocated. And what risks are there when it comes to inventory? Are they having CCTV camera? Are they having proper record keeping system? Nature of related internal controls, what kind of internal controls they are having? Whether adequate procedures are expected to be established and proper instructions are given, whether you are giving proper instructions to your team to do how to do the counting of physical verification, timing, at what time you are doing, how far from the balance sheet date you are doing it, whether the entity maintains perpetual inventory system or periodical inventory system, what kind of records are maintained, at what locations the client has stored the inventory, because of the location at which they are kept, are they posing any threat to the quality of the stock, and even whether any expert's assistance is needed. Sometimes in order to check the inventory, your alone expertise will not be enough. You might be required to take some help of another expert. So determine whether any expert's help is needed. So whenever you go and attend physical verification on your own, these are the things which you need to keep in mind. Now, one more thing. Sometimes what else will happen is management conducted physical verification. They invited, you did not go. Then you thought of doing physical verification on your own, but because of some extreme circumstances, doing physical verification has become completely impracticable. Management first called you, you did not go. You thought, okay, I will take my engagement team on some alternative day and go and do the physical verification. But that also did not happen. Why that also did not happen? Why? Because some unforeseen circumstances have occurred, like some calamity is there, some floods are there, so whatever it is, some social riots are happening. So because of unforeseen circumstances, because of unavoidable circumstances, attending the physical inventory counting has become completely impracticable. It is not at all possible for you to go and check the stock physically. You did not attend management's inventory counting. You thought of going on some alternative date. That also did not happen. Now it is completely impracticable. Then what the standard says, sir? Then the standard says you try to perform alternative audit procedures. What the standard is asking you to do? Perform alternative audit procedures. Sir, what could be alternative audit procedures? That's up to your choice. You apply your professional judgment and decide what I can do in this case to obtain audit evidence. I'm not able to attend the premises. I'm not able to do the physical counting. What else I can do to obtain audit evidence? You think of it on your own. So try to perform alternative audit procedures to obtain audit evidence. And sometimes what will happen is even alternative audit procedures are also not giving you audit evidence. You tried to perform alternative audit procedures, but that alternative audit procedures also did not give you audit evidence. Then finally what you should do, sir? You have to finally modify your opinion. Consider modifying your opinion. And what kind of modification, sir? I will say here what kind of modification means either a qualified opinion or a disclaimer of opinion. Sir, why qualified or disclaimer? Why? Because this is a case where you are unable to obtain audit evidence. So consider giving either qualified or a disclaimer of opinion. And one important thing here, the difficulty of time or cost involved. This sentence is very important for true or false statements. The difficulty of time or cost involved is in itself not a valid basis for physical verification impracticability. Very, very important for true or false statements. So what they are saying is you cannot say time and cost as a reason for impracticability. You can't say my client is located at very distant place. I have to travel for 2 hours to do physical verification. That's why impracticable. Can I use that reason as a impracticability? No. Can I say if I have to go to that warehouse where the stock is kept, I need to incur 2000 rupees of charges. That's why it is impracticable. Can I say it? No. The difficulty of time and cost cannot be used as a reason for impracticability. When I say impracticability, that should have happened because of circumstances beyond the control of auditor, which auditor can't control, like natural calamities, riots, etc. So that's what this sentence is. Sometimes they might ask you true or false statements. It will be like the difficulty of time or cost involved is in itself a valid basis for impracticability. Do you agree? No, it is not in itself a valid basis for impracticability. And one more last point regarding inventory. Sometimes you might have a stock forming part of your balance sheet, but the stock is in the custody of a third party. Your client is not having possession. Some third party is having possession of the stock. Like your client is a consignor. The stock is lying with the consignee. That stock will form part of your client's books only. But your client is not having possession. That custody is there in the third party who is consigning. How you will get the evidence, sir? So what the standard says here is, when inventory is under the custody and control of third party, but it is material, you should even obtain evidence regarding that also. But how, sir? By performing some procedures. What are they? Number one, request external confirmation from the third party. Ask external confirmation from the consignee. Send a confirmation request. Dear consignee, I am an auditor of your consignor. Let me know how much stock you are having. So request external confirmation. But sometimes external confirmation might not be reliable. Why? Because the consignee is a related party of your client. So you thought they are manipulating. If you find that external confirmation is not giving you complete evidence, then you perform other procedures also. Like if possible, go and attend that consignee's premises also. Or if possible, try to arrange another auditor. If you know any person there at the consignee's location, ask him to go and do the verification on your behalf, and even check appropriate documentation. Check whether any documentation is there regarding the movement of the stock. So when the stock is lying with a third party, but it is material, you should try to obtain evidence in this manner. Try to get external confirmation. In addition to that, try to perform extra procedures also. That's all. This is what SA 501 says to obtain audit evidence regarding existence and condition of inventory. A quick recap if I do. First, try to do physical verification. If you are unable to attend, try to do the verification on your own. If that is also impracticable, try to perform alternative audit procedures. If they are also not practicable, try to modify your opinion. In addition to that, if when any stock is lying with a third party, you should even try to obtain evidence regarding that also. So one aspect of SA 501 we have completed. Coming to the next one. Now coming to the second item regarding which SA 501 is giving evidence, which is related to completeness of litigations and claims. So as an auditor, you need to perform audit procedures to obtain audit evidence whether your client has disclosed all the litigations and claims in the financial statements, or they are hiding something from the shareholders. Now how you will try to obtain audit evidence? So let us see what does the standard say. First, the standard says try to identify whether there is any risk of material misstatement regarding litigations and claims. What the standard will ask you to do first, the auditor, like if I read the sentence here, the auditor shall design and perform audit procedures in order to identify litigations and claims which may give rise to risk of material misstatement, which means as an auditor, first you should find out, is there any possibility of hiding some litigations and claims from the shareholders? They are not first asking you to directly identify hiding of litigations and claims. First, what they are asking, first to find out, is there any risk, is there any possibility of hiding litigations and claims? So first they are asking you to identify the risk of material misstatement, not directly the misstatement. So how can I identify that risk of material misstatement regarding litigations and claims? So by simply doing three things. What are they? First, go and directly inquire with the management. First, what I should do? Go and inquire with the management. Sir, did you disclose all the litigations and claims, or did you hide anything from the shareholder? In addition to that, if there is any in-house legal counsel, go and inquire with them also. Then read the minutes of the meeting of the top level management, this audit committee minutes, board of the directors minutes. Go to the minutes of the meetings and find out whether any external lawyers have been appointed for fighting the cases. And finally, check the legal expenses account also. Try to compare the legal expenses of the current year with the last year. Check whether there is any huge increase or decrease. So first, auditor should do three things to identify, not misstatement, to identify what? Is there any possibility, is there any risk of happening of misstatement in the litigations and claims? By doing three simple things. What are they? First, inquiry. Inquiry with whom? Inquiry with management. Those charged with governance, legal counsel. Next one, reading the minutes of the meeting. Then after that, finally, review the legal expenses account. So by doing these three things, there could be two outcomes possible. Auditor might find out risk of material misstatement. Yes, there is some risk of hiding some litigations and claims in the financial statements. Another outcome could be auditor did not find out any risk of material misstatement. He inquired with the management, he read the minutes, he verified the legal expenses, he did not find anything suspicious. See, if he did not find out any risk of material misstatement, you can stop with these three procedures. But in case if the auditor identifies risk of material misstatement, if he comes to know that yes, some litigations and claims are hidden in the financial statements, if he gets that doubt, then he will perform the next step. If he finds that by performing these three steps, he did not find out any risk, there is no possibility of hiding litigations and claims, you can stop by doing these three activities. But in case if you find any risk of material misstatement, then you have to perform the next step. So what is that next step, sir? See the terminology here. If the auditor assesses, that means if the auditor identifies, yes, there is a risk of material misstatement regarding litigations and claims, then only he will perform this extra procedure. What is that extra procedure, sir? Seek direct communication with the entity's external legal counsel. If he finds any doubt, what he should do? He should first go and directly communicate with entity's external legal counsel. Whoever external lawyer is appointed, go and directly communicate with him. Who will communicate? Auditor will communicate. With whom he will communicate? External legal counsel. When he will communicate? If we came to know that yes, there is some risk of material misstatement regarding litigations. If he doesn't find any risk, he will end his audit procedures here only. He will come to this step only when he identifies, yes, there is a risk of happening of misstatement in the completeness of litigations and claims. So auditor should seek direct communication with entity's external legal counsel. Sir, how he will communicate, sir? Through a letter of inquiry. How the auditor will communicate? Through a letter of inquiry. Whatever information he wants to know, he will write a letter of inquiry. But in writing that letter of inquiry, he will take the help of the management. Why? Because you will know only external legal counsel. You don't know how to communicate, whom to communicate, etc. So you will communicate with the external legal counsel through a letter of inquiry, which will be prepared by management and it will be sent by auditor. Management will prepare it, but auditor will send it. And in that letter of inquiry, the auditor will ask external legal counsel to communicate directly with whom? Auditor. So if the auditor finds risk of material misstatement, he shall communicate with entity's external legal counsel through a letter of inquiry prepared by the management, sent by the auditor, asking the external legal counsel to respond directly back to auditor. So communicate with him. Sometimes what will happen is, see, if everything goes well, no issue. Management prepared the letter of engagement, the external legal counsel responded, everything goes well, no issue. But when the problem arises, is management is refusing to communicate with entity's external legal counsel, or management gave permission, you sent it to external legal counsel also, but external legal counsel is not responding, he is prohibited from responding, your client is prohibiting the external legal counsel to respond back to you, or external legal counsel is prohibited by his rules and regulations, like bar council related rules and regulations, whatever could be the reason. Either management is not permitting you to communicate with external legal counsel, or management permitted but external legal counsel is not responding, or he is prohibited from responding. If any of these things happen, then what the standard will say is, that means you are not able to communicate with entity's external legal counsel. Then the standard will say, perform alternative audit procedures. What the standard has told? Perform alternative audit procedures. Apply your mind. Think of any alternative things which you can do to obtain audit evidence and perform that alternative audit procedures. If alternative audit procedures are also not possible, then modify the opinion. If alternative audit procedures are also not possible, then what auditor should do? Modify the opinion. Here also what modification? Either qualified or disclaimer. Why? Because it is a case of non-availability of audit evidence. And next point, in some cases, the auditor might feel that just communicating through letter of inquiry alone will not be enough. He might feel that it is necessary to directly go and have a direct contact with the entity's external legal counsel. In some cases, generally we communicate with entity's external legal counsel through letter of inquiry. But in some cases, auditor might feel that just communicating with letter of inquiry alone might not be enough. He might be required to go and meet him personally. Sir, when that requirement arises, so that could be the case when the risk is a very significant risk. It is a very big risk, or the matter is very complex. The matter is very difficult to understand, or there is a disagreement between management and entity's external legal counsel, or whatever entity's external legal counsel is saying, whatever your management is saying, both are not matching. Then also you might feel that for extra clarification, you will go and meet with the legal counsel directly. In one of the examination, they have tested only this point as a question. How they have framed a question is, in some cases, auditor might feel that he has to go and meet with the entity's external legal counsel personally. In what circumstances auditor might have that requirement to meet with the entity's external legal counsel? What are the circumstances? So these three circumstances, what are they? When the risk is a significant risk, when the matter is very complex, when there is a disagreement between management and entity's external legal counsel. Clear? And in addition to all that, the auditor should even ask a written representation from the management, ask the management to give a written confirmation that they have disclosed all the litigations to the auditor and even they have presented it in accordance with applicable financial reporting framework. That's what you need to do in order to obtain evidence regarding litigations and claims, which SA 501 has suggested. Very simple, a quick recap. First, identify risk of material misstatement by doing three things. Now, by doing that three things, risk of material misstatement could be there, could not be there. If it is not there, well and good. If it is there, auditor should directly communicate with entity's external legal counsel. How he will do it? Through a letter of inquiry prepared by management, sent by auditor, asking external legal counsel to respond back to auditor directly. But either if the management refuses or external legal counsel prohibits to respond, perform alternative audit procedures. If they are also not giving audit evidence, modify the opinion. In some cases, you might feel like going and meeting with the legal counsel directly. What are that circumstances? In addition to all that, even request written representation also. Clear? Now the final thing is segment information. Very simple here, nothing much specific here to revise. So what they simply say here is we have a dedicated accounting standard talking about segment information, AS 17. So they will ask you to check whatever segment information which your client has presented, whether that information has been prepared and presented as per the requirements of applicable financial reporting framework, which is AS 17. That's all. The summary is that only. Whatever segment information which your client has presented, whether they have presented all that segment information in compliance with what? In compliance with applicable financial reporting framework, which is AS 17. So like if I quickly take you through it, the auditor shall obtain audit evidence regarding presentation and disclosure of segment information. How? First, understand what methods are used by the management in determining segments. Like in AS 17, there will be calculation, how to identify primary segments, geographical segments, etc. etc. So first you understand what are the methods used by the management to determine segment information. Then analyze whether that methods are in accordance with applicable financial reporting framework. Whatever methods the management has used, whether they are as per applicable financial reporting framework or not. And wherever possible, test the application of such methods. Since you also have knowledge of AS 17, you do the calculations on your own and try to compare it with the management's calculation. And wherever suitable, try to perform analytical procedures on the segment information. And specifically what I will try to understand. So here you are saying obtain an understanding of methods used by the management. No, what methods you will understand regarding the management, or what methods you will understand regarding the methods used by the management regarding segment information. So what I will try to understand is like how the sales, transfers and charges have been allocated between the segments, how the sales are divided, on what basis they are divided, how the expenses are divided, how the charges are divided, and how inter-segment elimination has been taken place. That I will understand. And if there are any budgets, I will try to compare the budgeted information with actual segment information. I will try to understand how the assets are allocated and even consistency with the prior periods, whether when compared with the last year, consistency is there or not. Last year geographical segments are presented. In the current year also, whether geographical segments are only there or some deviation has happened. This consistency I will check. That's all. So if I have to end it with one line, I will simply say whatever requirements of AS 17 or applicable financial reporting framework are there regarding segment information, whether they have been complied with or not, this is what I need to check. So this is what the guidance provided by SA 501 to obtain audit evidence regarding three selected items. What are that three selected items? So those three selected items are going to be obtaining evidence regarding existence and condition of inventory, completeness of litigations and claims, and finally segment information. Clear? Very important standard for case scenario based MCQs and also descriptive questions. Sorry. So with this, we are done with SA 501 successfully. Let us now proceed further with remaining standards. Now we will revise SA 505. So this is also a bit important standard which is relating to external confirmation. So let us do the revision quickly now. What does this SA 505 talk about regarding the external confirmation? First, we need to understand the meaning of external confirmation. So what is the meaning of external confirmation? So the definition says external confirmation is a written confirmation which is obtained by auditor from third party outside of the client. So a written response obtained by the auditor from a third party, either in paper form or electronic form, that we call it as a external confirmation. Like I'm an auditor of a company, I want to know whether bank balances are correct or not. I asked a written response from the bank manager, some third party outside of my client. So if the third party responded, I used external confirmation here. I want to know whether accounts payable balance is correct or not. Send external confirmation. I want to know accounts receivable balance is correct or not. You have communicated directly with the directly with the debtor. External confirmation. So a direct written response obtained by the auditor from a third party will be called as external confirmation. Now, sir, if auditor confirmed the balance over a phone call, can that be called as external confirmation? No. Why? Because the definition very specifically says external confirmation is defined as a direct written response. Written response they are specifically saying. So oral response from a third party will not play any role as external confirmation. Only written response is considered as external confirmation, be it in paper form or it could be in electronic form. Next, this external confirmation request can be of two types. One is positive confirmation request and the other one is negative confirmation request. Now, what is positive confirmation request? Positive confirmation request refers to such a confirmation request where auditor will expect a third party to respond. Either the third party agrees or disagrees with the information provided in the request. Positive confirmation request is such a confirmation request where auditor will expect a third party to respond. Either they agree with the information or disagree with the information. Or if the auditor directly asks the information from the third party, that also we call it as positive confirmation. Like I'm asking the debtor, sir, I came to know that you have to pay 10 lakh rupees to this client. Please confirm whether you are required to pay 10 lakhs or not. So I'm expecting a third party to respond. Either he agrees or disagrees. Or if I'm asking directly, like, sir, I'm an auditor of this company. I came to know that you are a debtor. Please let me know how much amount you are required to pay. Asking the information directly from the third party. This also will come under positive confirmation request. Whereas negative confirmation request refers to such a confirmation request where we expect third party to respond only when they disagree with the information provided in the request. So if we expect a third party to confirm back to us, to reply back to us only if they disagree with the information contained in the request, that we call it as negative confirmation request. Now, which one is more reliable, sir? Positive confirmation request is more reliable. Does that mean negative confirmation request cannot be used at all? No, you can use it, but that will give less convincing evidence than when compared with the positive confirmation request. Even the standard has told us in what circumstances we can use a negative confirmation request, which we will talk about in a few minutes. So this is what regarding two kinds of external confirmation, positive, negative. There are few more definitions which we need to revise. One is exception. Sir, what do you mean by this exception? So exception means if there is any difference between information which is there in the confirmation request and the response provided by third party, that difference we call it as exception. Like I mentioned in the confirmation request, dear debtor, my client is saying that you are required to pay 10 lakh rupees to my client. Please confirm whether you are required to pay 10 lakhs or not. I got a response from the debtor. He told, no, sir, I am not required to pay 10 lakh rupees. I am required to pay only 9 lakh rupees. Now there is a difference between information which is there in the confirmation request and the response provided by third party. This difference itself we call it as exception. But one important thing here is exception doesn't always mean a misstatement. This exception doesn't always mean misstatement. Why? Because sometimes exception could arise not because of mistake in your client's books, but that could arise because of misstatement in the third party's books of accounts. So we understood exception. What I'm saying extra is exception doesn't always mean a misstatement. Why? Because sometimes exception could occur because there is a mistake in the third party's books, not in your client's books. Clear, everybody? So this is what regarding exception. Now one more definition, which is non-response. So what do you mean by non-response? If you sent a confirmation request, either positive or negative, but that has been returned undelivered, the third party was unable to be found out and you got it back. Like you sent a mail, immediately you got a reply that the email address which you have used does not exist. So it has been returned undelivered, non-response. Or you posted a letter, but the third party was unable to be found. You got that post back. So you send a confirmation request, either positive or negative. If it has been returned undelivered, that scenario we call it as a non-response. Or you have sent a positive confirmation request, it has reached the third party also, but the third party didn't respond appropriately, he did not respond appropriately, that also we call it as non-response. Any confirmation request, either positive or negative, it has been returned undelivered. Or you send a positive confirmation request, it reached the third party also, but the third party did not respond, this also we call it as not response. However, one thing you need to keep in mind, if you send negative confirmation request, if it reached the third party, but the third party did not respond, will this also be called as non-response? No, this will not come under non-response. Why? Because when you send negative confirmation request, when you reach the third party, if he did not give you a response, that means that it is an implied implication that third party has agreed with the information. Why? Because we expect a third party to respond back only when he disagreed. No. So that's why if you send a negative confirmation request, if it reaches the third party, but if he is not responding, this will never come under non-response. Non-response covers only these two cases. Clear, everybody? So with this, we are done with the definitions. Now let us come to the context of this standard. So the standard says that if you want to obtain relevant and reliable or sufficient and appropriate audit evidence from external confirmation procedure, you need to follow some steps. You need to have control over 4 steps. So what are that 4 steps means? If you want to get best evidence from external confirmation, 4 steps you need to have control. So what are that 4 steps means? That is what has been highlighted here. First, determine the information to be confirmed or requested. First, you have to select regarding which information you have to send a confirmation request. Second step, select the appropriate confirming party. Decide who is the appropriate confirming party. Third one, design your confirmation request. And finally, after that, you have to follow up on your send it and follow up on the confirmation request. So 4 steps, if you maintain control, you will get best evidence from external confirmation. What are that 4 steps? Determine the information regarding which you want to send a confirmation request. Number 2, select the appropriate confirming party. Number 3, design the confirmation request. Last one, send it and do the follow-up wherever necessary. So let us talk about each and everything in a detailed manner. First one, determining the information. First, decide which information you want to get external confirmation. So if you give a thought, why we use external confirmation? For getting confirmation regarding which kind of items? So the thought which will come to your mind is, sir, we use external confirmation to use it to confirm whether debtor's balance is correct, whether accounts receivable balance is correct, whether bank balances are correct or not, whether inventory held with a third party is correct or not. So we mainly use external confirmation regarding account balances and their elements like amounts and balances, like bank balances, debtors balances, creditors balances, etc. But do you think the use of external confirmation is restricted only to these amounts and balances? Can you use it only for the amounts? Can't you use it for other purposes? No. We can even use external confirmation for qualitative aspects also. For other than amounts and balances also we can use it. Like what, sir? You want to know whether the terms of the, when you want to confirm terms and conditions of contracts. Like whether discount is really given or not, whether credit sale is made or cash sale is made. These kind of terms and conditions also you can get a confirmation. Or whether really a transaction happened between your entity and third party, that also you can confirm. Or even you want to know whether your client has entered into any side agreement apart from main agreement, you want to know, that also you can get a confirmation. And not just that, if your client is saying, sir, our property we have given as security for the banker, so that's why original documents of this land are not there with us, they are lying with the banker. You want to know whether banker is really keeping that original documents of the property. How you can get to know? Send a confirmation request to the banker. So the point which I want to make here is, we use external confirmation, yes, agreed for amounts and balances. But the use of external confirmation is not just restricted to amounts and balances. We can use it for other qualitative aspects other than amounts and balances, like terms and conditions of the contracts and also side agreements, existence of the transactions or property documents given to the banker. So like this, we can use it for other qualitative purposes also. So whatever it is, first select the information regarding which you want a confirmation. Then select the appropriate confirming party to whom you have to send the confirmation, that you have to decide. Like for example, Reliance Industries Limited is a debtor for your client. You have to send a confirmation request. Will you send the email to official email address of Reliance Industries Limited? No. You want to know who is the concerned person in the Reliance Industries Limited, with to whom if you send the confirmation request, you will get the response. So like this, you have to select the appropriate confirming party. Why? Because when you send the confirmation request to the appropriate confirming party, then only you will get the responses, then only those responses will be reliable. But in order to know who is that appropriate confirming party, I become helpless here and I have to take the help of the management. Understood? At this stage, when selecting the appropriate confirming party, I need to take the help of whom? Management. Why? Because I will not know who is the concerned person in the third party to whom I have to send the confirmation request. So whatever it is, second step, select the appropriate confirming party. Third one, design the confirmation request now. What do you mean by designing here? Like either you want to send positive confirmation request or negative confirmation request. You want to send it in an electronic form or you want to send it in a paper form. So you have to take that decision. And that decision will be depending on so many factors. It depends on risk of material misstatement. When the risk is very high, then you will go for positive. When the risk is very low, then you will go for negative. And it also depends on presentation, like you have to send a positive or negative. Prior experience, even you can use your past experience here. And also it depends on that concerned item of financial statements. If the item is very material, very important item, use positive confirmation request. If the item is very immaterial or insignificant, use negative confirmation request. And also decide on method of communication. Like as I've told, either you want to send it by email or physical post, or even management's authorization. What some third parties will say is, if you send a confirmation request, they will say if you get the approval of the management, then only we will respond back. So now what you should do is first go to the management, get the approval, then only third party will respond. Consider this requirement also. And also how far the third party is ready to respond back to you. Sometimes third parties will have a lot of patience. Even if you ask them invoice wise details, then also they will share that with you. So if I know the third party is such a humble person, I will ask invoice wise details. If I came to know other third party is not so humble, if you ask invoice wise details, instead of responding back, he will delete that email. There you will not take the risk of asking invoice wise details, but instead what you will do, I will ask only total balances. So keeping all these factors in mind, you will design the confirmation request. After designing confirmation request, will you keep it safe in the locker? No. What is the next step? Send the confirmation request. Finally, post or email that confirmation request, and wherever appropriate, do the follow up. Where I will do the follow up? I will do the follow up only in the case of positive confirmation request. I will not do the follow up in the case of negative confirmation request. So why? Because in the positive confirmation request, I expect a third party to respond. Either he agrees or disagrees. So within a reasonable time, if I don't get a response, I will send a pop-up mail. Sir, I have already sent you a mail. Please check it and respond back. In the case of negative confirmation request, if you don't get a response, you will assume that the third party has agreed. So that's why you need to get a confirmation request. You need to send the confirmation request, and wherever suitable you send a follow-up request, and generally where it will be suitable, only in the case of positive confirmation request. And one more thing, I told negative confirmation requests are less reliable. Does that mean you should not use them at all? No, you can use it, but when you can use it, you can use in such areas where the risk is very low, and when you came to know that controls are very effective in that area, and the transactions are very small, homogeneous repetitive transactions, very small in value, or you are expecting a very low exception. In this area, the chances of differences are very rare. And one more thing, when you know the third party very well, that if he finds something wrong, he will definitely respond. When you know the third party very well, that the third party, if he gets the confirmation request and if he finds something wrong, he will definitely respond. Such a confidence you have on third party, then also you can use a negative confirmation request. If I have to end it in one single line, wherever risk is very low, wherever items are immaterial, there you can make use of negative confirmation request. Don't use negative confirmation request as a sole substantive audit procedure, as a only audit procedure in those areas where the risk of material misstatement is high. If you find the risk as very high, don't use only negative confirmation. In those areas, either use positive confirmation request or use negative confirmation in combination with other audit procedures. Don't use negative confirmation request as the only audit procedure wherever risk is very high. You can use in these areas like risk is low, controls are effective, items are small and homogeneous, very low exception, and you know the third party very well that he will not disregard your request. And sometimes what will happen is, you want to send a confirmation request to the third party, but the management is refusing you to do it. Management is stopping you from communicating with the third party. Now what I should do? So when the management refuses the auditor to send a confirmation request, the standards say first to go and ask the management reason. Sir, why are you stopping me from communicating with a third party? Ask the management to give the reasons. Now, whatever reasons management have given, find out find out whether they are reasonable or not. So whatever reasons which are given by the management, find it out whether they are reasonable or not. So let me try to summarize in the form of a chart here what auditor should do when the management refuses. So if the management refuses, first auditor should find out reasons. Now, at the time of once the management give the reasons, find out whether there is a reasonable justification. Yes, management has given valid reasons why they are stopping me from communicating with a third party. Then what the standard will say is perform alternative audit procedures. If alternative procedures are not possible, if you are unable to obtain evidence even from alternative audit procedures, then modify your opinion. Then what we should do? Then we have to modify our opinion when there is a reasonable justification. Very simple, guys. Try to obtain reasons, find out if there is a reasonable justification. Yes, there is a reasonable justification, perform alternative audit procedures. If alternative audit procedures are also not possible, then modify your opinion. Now, coming to the other case. Now let us talk about other case. Like you have asked the management, sir, why are you refusing me to communicate with the third party? Now they are giving me reasons for which there is no reasonable justification. They're not giving me reasons for which they're not giving me reasons which are having justification. They're giving some bullshit reasons. They're saying, no, sir. So don't communicate with the third party. We don't have any valid reason. But they're trying to say something, but for which there is no reasonable justification. So if there is no reasonable justification, what the standard will ask you to do is reassess the risk of material misstatement. What as an auditor I should do? Reassess the risk of material misstatement. Why? Because you got to know about the management now. Management, when I try to communicate with a third party, they are giving me some reasons and which are not at all valid, and they are stopping me from communicating about third party. Now you got to know about the true nature of the management, that they are not honest, that they are not having integrity. So that's why reassess the risk of material misstatement. Why? Because you got to know the information about the client now. Earlier you thought management is honest, you thought risk would be low, you might have planned less audit procedures, but now you got to know the true nature of the management, reassess the risk of material misstatement and make changes to your audit procedures. So reassess the risk of material misstatement and even consider modifying the opinion in your auditor's report also. So this is what auditor needs to do in case if the management refuses the auditor to communicate with the third party. First, understand the reasons. If there is reasonable justification, perform alternative audit procedures. If alternative audit procedures are also not possible, then modify. If there is no reasonable justification, first reassess the risk of material misstatement and directly modify the opinion. Now, one more last point here regarding external confirmation. What if responses to external confirmation are not reliable, which means management gave permission, you communicated with the third party gave response also, but the problem is those responses are not reliable. When you will generally get that doubt, responses to external confirmations are not reliable, when you came to know that the third party is not independent of your client. That is, your client's management and the third party colluded with each other, and your client made the third party to give you wrong responses. So if you came to know that responses to external confirmations are not reliable, then what you should do? Let us see what they are saying. If the auditor identifies factors that give rise to doubts about reliability of responses to confirmation requests, then the auditor shall obtain further audit evidence to resolve the matter. That means you need to perform in-depth audit procedures to find out how far the management's evidences are reliable. And if the auditor determines that confirmation request is only not reliable, why? Because third party is saying something and from other evidences you concluded that responses given by the third party is completely not reliable. That means your management made the third party gave you wrong responses. Here also the auditor need to reassess the risk of material misstatement and make suitable changes to your audit procedures. Why? Because here also you came to know about the true nature of the client, that client has made the third party give wrong responses. That means they are not honest. You got to know this extra information regarding the nature of the management. Now try to make changes to your audit procedures by increasing the risk of material misstatement. Clear? So this is what auditor needs to do when he found that responses to external confirmations are not reliable. This is what simply SA 505 says. So we understood five definitions. Then we have seen that if external confirmations have to give you best evidence, you need to maintain control over four steps. What if the management refuses you to communicate with the third party? What if confirmation requests are not reliable? In addition to that, in what kind of circumstances we can make use of negative confirmation request? Clear everybody? So three standards we have revised successfully: 250, 501 and 505. Now we will try to revise SA 580. So just now we have completed SA 505, which is talking about external confirmation, whereas SA 580 will be talking about written representation. Now first we will understand what is the difference between external confirmation and written representation. I told that external confirmation is a written response, is a written confirmation obtained by the auditor from third parties. Whereas written representation means it is a written confirmation obtained by the auditor from the management of the organization, that I call it as written representation. So once again, I am repeating, if the auditor is getting a written response from a third party, that we call it as external confirmation. On the other hand, if the auditor is getting a written confirmation from the management, internal. So from the management, if the auditor is getting a written response, written confirmation, that we call it as written representation. So does that mean to the auditor, financial statements will be given? No. Financial statements will be given to the auditor. Books of accounts will be given to the auditor. Can I include financial statements and books of accounts also in the definition of written representation? No. The written representation does not include financial statements, assertions therein, or books of accounts. But regarding that financial statements, regarding the assertions in the financial statements, or regarding the books of accounts, if the management gives you some written confirmations, that we call it as written representation. So written representations are confirmations given by management. However, we can't say financial statements, books of accounts as written representation. Regarding that items of financial statements and books of accounts, if the management gives you some confirmations, that I call it as written representation. Now, let us see what role does this written representation play in the audit. Do you think written representation are a evidence? Do you think written representation are a source of evidence to the auditor? Yes, written representation are one of the sources of audit evidence. But the problem is written representation can't act as a sole audit evidence, which means you can't use only written representation as a audit evidence. You can't use it. Written representation are only like supporting evidences. They cannot provide evidence on their own, which means you can't use written representation only as a evidence. You can use it only as a supporting evidences. Clear? Now coming to the next point, regarding what matters you need to get the written representation. For which matters you have to get the confirmation from the management. So SA 580 says in its objective that in two cases obtaining written representation is mandatory. What are that two matters? Number one, every auditor should get a written representation from the management that they have fulfilled their responsibility for the preparation of financial statements, and also they have completely disclosed the information to the auditor. Completely disclosed information to whom? Auditor. They did not hide anything from the auditor. That auditor should ask the management, every management of the client, to get this written representation concerning this matter. Which matter? That the management has fulfilled their responsibility for preparation of financial statements, and also they have disclosed the information completely to the auditor. They did not hide anything from the auditor. That they have to give a written confirmation. Just giving oral confirmation alone will not be enough. The management has to write it on their letterhead, sign it, affix the company's seal, and give it to the auditor. So that is what the first objective here. If you observe, the objectives of the auditor are to obtain written representation from whom? From the management, that they believe that they have fulfilled their responsibility for the preparation of financial statements, and also they have completely provided the information to the auditor. Every management should give this written confirmation. Sir, we fulfill our responsibility for preparation of financial statements. We have completely provided the information to you. We did not hide anything from you. Ask the management to give written confirmation. This is mandatory. And also to support other audit evidence, if there is any requirement of the standard, assume that some standard in some other matter, they ask the auditor to obtain written representation. Like previously we have revised SA 501. There I told that in the second issue, that is when you try to obtain regarding litigations and claims, along with so many audit procedures, they have mentioned even one more thing: the auditor should obtain written representation from the management regarding litigations and claims. Now it becomes mandatory for the auditor to obtain written representation regarding litigations and claims. Why? Because it is a requirement of SA 501. Similarly, when we revise the next standard, which is SA 570, there also they will say auditor should obtain written representation regarding going concern assumption. This is also mandatory. So the point which I want to conclude here is, whenever there is a requirement of any standard, there also it is mandatory for the auditor to obtain written representation. And in rest of the cases, it is up to auditor's choice. In rest of the cases, it is up to auditor's choice to decide for which matter he wants written representation, for which matter he doesn't want written representation. But these two things are mandatory, that he should ask the management to give written confirmation that they fulfill the responsibility and completely disclose the information to auditor. And also whenever there is a requirement of the standard, there also it is mandatory. In rest of the cases, it is up to auditor's choice whether he wants to get a written representation or not. So this is what regarding objective of the auditor. Now, coming to the next point, from whom auditor will request written representation? From whom auditor will request written representation? Obviously, you will say, sir, he will request it from management. That's what you are saying. But when I say he will request from the management, from whom in the management? When I say management, so many people will come in the management definition. From exactly whom the auditor will request a written representation from? So if you ask me, so many people will come under management definition, but we can't expect each and every person will have complete knowledge regarding the items of financial statements. So that's why what the standard says is, you should ask or you should request written representation from that part of the management who is involved in the preparation and the presentation of financial statements, or from whom we expect that they have good knowledge about the items of the financial statements. From that kind of management, we have to ask the written representation. Like if you ask me, generally if there is a CFO will be the person who will be concerned with the preparation of financial statements. If there is a CFO, I will ask written representation from CFO. If there is a CEO, I will ask written representation from CEO, or generally audit committee. So I will request written representation from that part of the management who have knowledge about financial statement preparation. Generally, I expect that these people will have complete information regarding financial statements. But sometimes what will happen is, you go to some CEO, CFO or audit committee, you ask them written confirmation, written representation. But they might respond back, sir, we don't have complete information regarding the item which you are asking confirmation for. So that's why we will not provide you with the written representation. Can the management say? Like for example, I went to the management, I went to the CFO and told, sir, SA 501 is asking me to obtain written representation regarding litigations and claims. So please give me written representations. I asked the CFO. Now CFO told me, no sir, I am not the concerned person who is looking into litigations. There is a dedicated legal team inside the company. They are the persons who are looking into that litigations. Since I don't have enough of knowledge, I will not give you written representation. Can the CFO escape saying this as a reason? The answer is no, he can't escape. Then what the standard says is, if the concerned management does not know the information regarding which auditor is asking written representation, then it is the responsibility of that management to go to concerned person in the organization, or even consult the expert, get the required information, then provide confirmation to the auditor. What the standard is saying, no management can escape simply saying we don't have knowledge about it, we will not provide written representation. No, management can't say. If they don't have information, what the management should do? Go to the concerned person or even consult an expert, get the required information, then provide written representation to the auditor. Sir, like who could be that concerned person? Who could be that expert to whom the management can approach and get the required information from? Like as you could see, that expert can be an actuary. Like as an auditor, you are asking the management to give confirmation regarding certain provision. But CFO told, sir, some actuary has calculated that provision. So what CFO should do? Go to that concerned actuary, get the information, then provide confirmation to the auditor. Or he could be a staff engineer. You're asking confirmation regarding some technical matter. CFO doesn't have knowledge. He might go to staff engineer, get the required information, then provide the written representation to you. Or even or even it could be an internal counsel like some lawyer. So even if you ask written confirmation from CFO regarding some legal issue, if CFO doesn't have information, go to that legal counsel, get the information, and then provide the written representation to the auditor. So no management can simply escape saying we don't have information, we will not provide written representation. No, they can't say it. Go to concerned person, even consult an expert, get the required information, then provide written representation to auditor. Clear everybody? Now talking about one more important thing regarding written representation, date of written representation, very important. Let me ask you one simple question. Between date of auditor's report and date of written representations, which date should be earlier? Straightforward question I am asking. One very simple question. Between date of auditor's report and date of written representation, which one should be earlier? Should the date of auditor's report be earlier? Should the date of written representation be earlier? The answer is date of written representation should be earlier than the date of auditor's report. Like for example, if you are signing the audit report on 30th of July, date of the written representation should contain date on or before 31st of July. Why, sir? Why date of written representation can't be later than the date of auditor's report? Why? Because written representation is evidence, no? Since written representation is evidence used in expressing the opinion, as we all know, the process of audit starts with auditor's appointment, then he will obtain evidence. After obtaining evidence, only opinion will be given. So that's why date of written representation, since it is a audit evidence will be obtained prior to expressing of the opinion. So that's why the date of written representation should always be earlier than date of auditor's report. It should not go after it. What will happen? It will go after. That will make you a fool. So assume that date of auditor's report is 31st of July and you have mentioned the date as 5th of August. Then what does it look like? It will look like you have given the audit report, then you have obtained audit evidence. So funny, no? So that's why the date of written representation should always be earlier than date of auditor's report. Now few more concerns. The few more thing is doubt as to reliability of written representation. Sometimes what will happen is you will ask the management to give written representation, but you might have suspicion. You will get a doubt. Management has provided you written representation, but sometimes you will get a doubt how far these written representations are reliable. When you will generally get the doubt regarding reliability of written representations? I will get a doubt regarding reliability of written representation when I have concerns about management's competence, integrity, and ethical values. When I came to know that the management is not capable enough, or the management is not having integrity, that is, they are not honest people, they don't have any ethical values, then immediately I will get a doubt that how far the written representations are reliable. Not just written representations, I should get a doubt regarding overall audit evidence when I have doubts about the management's honesty, competence, capability, etc. So particularly if the written representations are inconsistent with other audit evidences. You got some other audit evidences, you got written representations also, but both are not matching, then you have to immediately resolve the matter. You got some evidences, you did some inspection, got some evidences, that evidences is telling you something, but written representations are saying something else. You should immediately try to resolve the matter by performing audit procedures and find out whether evidences that you collected are wrong or management's representations are wrong. If evidences are only wrong, well and good, fine. But if you came to know that the written representations given by the management are only wrong, then what you should do? If the auditor concludes that written representations are only not reliable, then the auditor shall take appropriate action, including determining the possible effect on the opinion. That means even you should consider modifying your opinion when you have decided that written representations given by the management are not reliable. Clear? So very simple. When you they are saying reliability of written representation, when you will get that doubt, when you have doubt about capability, integrity, ethical values of the management, particularly when evidences are not matching with written representation, immediately resolve the matter. If you have finally decided written representations are only not reliable, then consider modifying your opinion. That's what they are trying to convey here. Now coming to the last point, what if written representations are not provided? This point is you ask a written representation, management gave, but they are not reliable. But this point is what? You ask written representation from the management, but they are not at all giving it. Then what you should do? So if the management does not provide one or more of the requested written representation, then the auditor shall immediately discuss the matter with the management. First go to the management and discuss with them, sir, why are you not providing me the written representation? As a part of that process, re-evaluate integrity of the management. So when you go and inquire with them, they will give you reasons. If that reasons are valid, well and good. If those reasons are not valid, reassess the integrity of the management. Analyze once again how far the management is honest. And then finally take appropriate action, including determining the possible effect on the opinion. That means finally here also consider modifying your opinion. That's it. So this is what the auditor should do if the management is not providing the written representation. Very simple things we have discussed in the standard: definition of written representation, how it can be used as audit evidence, and objectives of the auditor, and from whom auditor will request written representation, date of written representations, what if written representations are not reliable, what if management did not provide the written representation. So these are the things which we covered in SA 580. With this, SA 580 is also over. So 4 standards we have revised: 250 we are done, 501 we are done, 505 we are done, and 580 also we are done just now. Now we will revise the next standard. We will start with SA 510. So what is this SA 510 talking about? So SA 510, the title of the standard is Initial Audit Engagements and Opening Balances. So what is the title of the standard SA 510? Initial Audit Engagement and Opening Balances. So before we talk about what exactly this standard is discussing, first we have to revise the definition of the terms which are used in the title. So talking about initial audit engagement refers to such an engagement where the prior year's financial statements were unaudited. The prior year's financial statements were unaudited, or the prior year financial statements were audited but by a predecessor auditor. Who? Predecessor auditor. So initial audit engagement refers to such a audit engagement where either prior year's financial statements were unaudited, or the prior year financial statements were audited but by some predecessor auditor. Now who is predecessor auditor? Auditor from altogether a different audit firm. What do you mean by predecessor auditor? Auditor from a different audit firm who has conducted the audit of the previous year and who has been replaced by another auditor in the current year. If I have to put it in simple terms, initial audit engagement means the current year auditor is different from the previous year's auditor. This is what in simple terminology. If the prior year auditor, if the previous year auditor and the current year auditor both are not same people, then we call it as initial audit engagement. The same thing has been technically defined like this in case if the prior year financial statements were unaudited, or last year's financial statements were audited but by some predecessor auditor, some different audit firm has conducted the audit of the last year. So this is what regarding initial audit engagement. Now coming to the other term which is used in the title, they are saying something called opening balances. Now what is opening balances? As we all know, opening balances are those balances which are there at the beginning of the period. Before passing any transaction for the current year. And these opening balances are nothing but the last year's closing balances. And what information does this opening balances reflect, sir? So as per the standard, opening balances reflect two information. So what are that two information is? Opening balances reflect the effect of transactions which have happened in the previous year, and also they reflect the accounting policies which are followed in the previous year. So as per SA 510, opening balances convey two kinds of information. They convey the effect of the transactions which have happened in the previous year. At the same time, they convey the effect of accounting policies which are followed in the previous year. And when I say opening balances, don't just be of a wrong notion that opening balance includes only those items which are there in the balance sheet. No. Even those items which are there in the notes to accounts also will form part of opening balances. So don't imagine opening balances as only those information which is there in the balance sheet. Opening balances includes that information which is there in notes to accounts also. Like if I say contingent liabilities, where the contingent liabilities will be presented in the notes to accounts. Even contingent liabilities also will form part of opening balances, not just the items in the balance sheet. So we are done with the definition. We revised what is initial audit engagement. I told you what is predecessor auditor and what is opening balances. Now let us come to the objective of this standard. With what objective SA 510 has been introduced? So SA 510 says that when you are doing initial audit engagement, especially when the auditor is doing initial audit engagement, you will have two objectives. You need to obtain sufficient and appropriate audit evidence that opening balances do not contain any material misstatement that could affect the current year's balances. And this standard says, as an auditor, if you are conducting initial audit engagement, you need to obtain sufficient and appropriate audit evidence that opening balances are not containing any material misstatement which could affect the current year's closing balances. And also, you need to obtain audit evidence that whatever accounting policies are there which are reflected in the opening balances, they should have been consistently applied. One of the fundamental accounting assumption, no, consistency. What does consistency say? Whatever accounting policies you have followed in the previous year, the same accounting policies should be applied in the current year also. You cannot say last year I followed SLM, in the current year I will change it to WTB. You can't say that. And also, does that mean the standards will not permit you to deviate from the accounting policies at all? No, the standards will permit me to deviate in some circumstances. So, but even in that circumstances also, if you change the accounting policy, the standards will say that proper disclosure is required, that you need to obtain audit evidence. So two things here: opening balances are not containing any material misstatement, and whatever accounting policies are there which are reflected in opening balances, without any valid reason, they should not be changed. If there is a valid reason because of which accounting policies are changed, then as a auditor I need to check that whether the change in accounting policy has been properly disclosed in the financial statements as per applicable accounting standards. So that is what the objective of this standard. So if we go to SA 510 and check the objective there once. So if I take you through the standard, yeah, as you could see here, definitions we are done. So after definitions, objective. So the standard is saying, especially when you are doing initial audit engagement, the objective of the auditor is to obtain sufficient and appropriate audit evidence regarding two things. They are saying opening balances contain any material misstatement that affect the current period's financial statements. And also accounting policies reflected in the opening balances have been consistently applied. That means without any reason, accounting policy should not be changed. Or if there is a valid reason because of which there is a change in accounting policy, then I need to obtain evidence that the changes are properly accounted for and adequately disclosed and presented in the financial statements. So these are my objectives as auditor when I am doing initial audit engagements as per SA 510. Now the standard is saying to obtain sufficient and appropriate audit evidence, and we all know that we will obtain sufficient and appropriate audit evidence only when we perform audit procedures. So let us see what audit procedures I need to perform regarding opening balances. So if I quickly take you through it, the auditor, first audit procedure, what they are saying is I should read the most recent financial statements. Whatever recent financial statements are there, I should get a copy of the audited financial statements and I should read them. Especially opening balances related information, I will read it. Then the auditor shall obtain sufficient and appropriate audit evidence whether opening balances contain any material misstatement. But how should I do it? Determine whether prior period closing balances have been correctly brought forward. First, I will get the last year's copies of the audited financial statements, check whether they are correctly brought forward in the current year. I should try to match the current year opening balances with last year's closing balances. And determine opening balances reflect application of appropriate accounting policies. I will even check that whatever accounting policies are there which are reflected in the opening balances, whether they are appropriate. Like when I check the opening balances, I came to know that the client has charged depreciation on SLM basis. I should decide whether that SLM basis is appropriate. When SLM will be appropriate? When the consumption pattern of the machinery is expected to be uniform throughout its useful life. So like this, even I should check whatever accounting policies are reflected in the opening balances, are they appropriate? And even perform specific procedures like if the prior year financial statements were audited, if the last year's financial statements are audited, get the copies of audited financial statements. Get one copy of the audited financial statements of the last year. And evaluate whether any audit procedures performed in the current year provide evidence relating to opening balances. Sometimes you try to verify current year transactions, but that audit procedures will give you information regarding opening balances. Please be aware of that evidences. And finally, perform specific audit procedures. Like what? What is a specific audit procedure here is, I will ask the client to give me the opening trial balance. From the accounting software like Tally, etc., there will be an option to download opening trial balance. You can download the opening trial balance from the company, from the accounting software without any issue. So I will download the opening trial balance from the company's accounting software. I will get the copies of the last year's audited financial statements, and I will try to match whatever balances are there in the opening trial balance, they are matching with the last year's balance sheet or not. So these are the audit procedures which I will perform regarding opening balances, and by performing all these procedures, I will be in a position to decide whether opening balances contain a misstatement or not. Now, after performing this audit procedures, I will have my findings now. Now, how that findings will have an impact in my auditor's report, how that findings will affect my opinion. So that's what the E point is about: audit conclusions and reporting in relation to opening balances. How the findings in the opening balances will affect my opinion. Here they will try to say something which we are already aware of it. If the auditor concludes means what? When we say concludes, whether auditor is having evidence or not having evidence, auditor is having evidence. So if the auditor concludes that opening balances contain a material misstatement, you have performed audit procedures and you have obtained audit evidence, on the basis of sufficient and appropriate audit evidence, you have concluded that opening balances contain a material misstatement. So you have a evidence and you came to know that financial statements contain a material misstatement. What you will do? Will you give modified opinion or unmodified opinion? I will give modified opinion. Which kind of modification here? Since it is a case of availability of audit evidence, which opinion I will give? Which modification? I will give either a qualified or adverse opinion. So once again, I am revising the circumstances. They are saying auditor concluded. I am asking you when the auditor will conclude, when he has evidence or when he doesn't have evidence, when he is having evidence. So auditor is having evidence, and on that basis of evidence, he concluded that financial statements contain a misstatement, and now what opinion he will give? Modified opinion. And which kind of opinion? Qualified or adverse. On the other hand, one more scenario which could be possible is sometimes auditor will not be able to obtain sufficient and appropriate audit evidence whether opening balances contain a material misstatement or not. So if the auditor is unable to obtain audit evidence, then which opinion? Then which opinion? Then also modified. But which modified here? Either a qualified opinion or disclaimer. If the possible effect is only material, qualified. If the possible effect is material and also pervasive, then disclaimer. So this is what regarding how the findings in the opening balances will have an impact on the auditor's opinion. Similarly, you will have conclusions regarding accounting policies also. Here they say that if the auditor concludes that without any valid reason, accounting policies are not consistently applied. The client is not having any valid reason. Without any valid reason, they have changed the accounting policy in the current year. Last year, they followed SLM. In the current year, without any valid reason, they have changed it to WDV. Or sometimes what will happen is, there is a valid reason for change in accounting policy, but the management did not properly account or disclose for it in the financial statements. There is a valid reason, standard permitted to change the accounting policy. The client has changed it, but what the client has done a mistake is they did not properly disclose it. Observe carefully, guys, listen carefully. I am giving you two circumstances here. Either without any valid reason, accounting policy is changed, or there is a valid reason but management did not properly account for or disclose it. In this both the circumstances, the auditor shall modify opinion. And which kind of opinion? Either he should give a qualified opinion or an adverse opinion should be given by the auditor. Clear? So this is how the findings regarding accounting policies will have an impact on the auditor's opinion. And one more last point from this standard: modification to the opinion in the predecessor auditor's report. That means last year somebody else has done the audit. When I have taken the last year's audit report, I was able to see that the last year auditor gave a modified opinion. Just because last year's auditor's report gave a modified opinion, is there a mandatory obligation on the current year auditor also to compulsorily give modified opinion? The answer is no. Just because last year's audit report contained modified opinion, the current year auditor is under no obligation to mandatorily give qualified opinion or modified opinion. When the current year auditor also will give modified opinion? Because when the last year auditor, because of which reason he has given modified opinion, if the same reason remains unresolved, if the same reason remains material and relevant for the current year, then only current year auditor will modify. If the reason because of which last year auditor gave modified opinion, if that has been rectified in the current year, if that has been modified, if that has been adjusted in the current year, if it is no longer relevant in the current year, then the current year auditor unnecessarily will not modify. So current year auditor will modify opinion only when the reason because of which last year auditor gave the modified opinion, if that is not yet rectified, if it is still material and relevant for the current year, then only he will modify. So that's what they try to say here. If the predecessor auditor's opinion regarding the prior period's financial statements included a modification to the auditor's opinion, that remains relevant and material for current period's financial statements also, then only the auditor shall modify the auditor's opinion on current period's financial statements, which impliedly means that if the reason because of which last year's auditor gave modified opinion, if that is resolved, rectified, no longer relevant and material for the current year, then no need for the current year auditor to modify his opinion. Clear? So this is what they are in SA 510. Very simple. We understood definitions, initial audit engagements, predecessor auditor, and opening balances. Then we understood what are objectives of the auditor, audit procedures, impact on the auditor's opinion, and finally, what if there is a modification in the prior year's auditor's report. Clear, everybody? So that's all. Very simple standard. SA 510 also we are successfully done. Understood, everybody? Next one. The next standard which we take up will be SA 560. Important standard. Pay attention now. So we are going to take up the standard for revision now, which is going to be about subsequent events, and SA 560 is the standard which is talking about subsequent events. So first we should understand what is the definition of the subsequent events. How the term subsequent events has been defined in the SA 560. See, we all know subsequent events a definition as per accounting standards. So how the term subsequent events is defined under accounting standards? They say that those events which are happening between the date of financial statements and the date of approval of financial statements will be called as subsequent events. See, I am saying definition of subsequent events as per accounting standards. So accounting standards has defined the term subsequent events as those events happening between the date of financial statements and those events happening between the date of financial statements and the date of approval of financial statements. And the accounting standards divides that subsequent events into two categories, which in our common parlance we call it as adjusting events and non-adjusting events. Adjusting events are those events which conform to the conditions existing as on balance sheet date. Adjusting events are those events which conform to the conditions existing as on balance sheet date, whereas non-adjusting events are those events which conform to the conditions existing after the balance sheet date. That we call it as non-adjusting events. So this is how the term subsequent events was defined as per accounting standard. So they might ask you a question, what are subsequent events as per financial reporting framework? So nothing but they are asking you what are subsequent events as per accounting standards. If they ask you, you have to write this. Now, how the term subsequent events is defined under standards on auditing. Whatever I told you, that is definition as per accounting standards. Now, whatever I am going to explain, that is regarding standards on auditing. So even SA 560 has also defined the term subsequent events, but in a different manner. So how the term subsequent events is defined under standards on auditing is those events which are happening between the date of financial statements and the date of auditor's report. Those events which are happening between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge after the date of auditor's report. Those events which are happening between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge when? After you have signed the auditor's report. Assume 22-23 financial year. What is the balance sheet date? 31st of March 2023. Assume that the auditor signed the audit report on 31st of May. So some event happened between this date of financial statements and the date of auditor's report. Some event happened here. But auditor came to know about this event subsequent event after the date of auditor's report. After 31st of March, auditor came to know about it. The event which has happened before after 31st of May, auditor came to know about subsequent event, and that event has actually taken place between 31st of March and 31st of May. See, if the auditor came to know about subsequent event before the date of auditor's report, then there is no requirement of the standard only. when we start looking for guidance, when we need a standard, we need a standard. When I signed the audit report, but after signing the audit report, then I came to know that event which has happened in the past. Then only we start looking for guidance. No. So that's why subsequent events are those events which are happening or which have happened between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge after the date of auditor's report. This is how the term subsequent events has been defined. Very, very important. Events which are occurring between the date of financial statements and the date of auditor's report, but the fact become known to the auditor after the date of auditor's report. Those events we call them as subsequent events. So we understood what are subsequent events as per standards on auditing. Now, with what objective this standard has been given? What is the purpose of giving this standard? What this standard is providing guidance to the auditor? Let us see. So the objectives of the auditor are to obtain sufficient and appropriate audit evidence about whether events occurring between the date of financial statements and the date of auditor's report that require adjustment or disclosure in financial statements are appropriately reflected in those financial statements, which means as an auditor, you need to obtain sufficient and appropriate audit evidence that whatever adjusting events are there, whatever events that are happening between the date of financial statements and the date of auditor's report, and that too they are saying that require adjustment. That means they are specifically referring to adjusting events. So as an auditor, I need to obtain audit evidence that whatever adjusting events are there, whether they are properly reflected in the financial statements or not, and respond appropriately to facts that became known to the auditor after the date of auditor's report that they had been known to the auditor at the date would have caused the auditor to amend the auditor's report. Which means as an auditor, in case after signing the audit report, you came to know about some subsequent event, and if you believe that had I known about this event earlier, I would have amended my auditor's report. If such a fact came to your knowledge now, then you have to respond appropriately. Sir, how to respond appropriately? That's what the standard is going to explain. So very simple, two objectives. As an auditor, obtain audit evidence, whatever adjusting events are there, whether they are reflected properly or not. In case if you come to know about subsequent event after the date of auditor's report, then respond appropriately. How to respond appropriately? That we are going to see in a short while now. But first of all, before we can see whether they are adjusted or not, first we need to find out that subsequent events. No. So as an auditor, what audit procedures you will perform to find out whether there are any subsequent events or not. So let us try to pay some attention to audit procedures. So what procedures auditor will perform to identify subsequent events? Let us see. So the auditor shall perform below procedures. What are they? First, understand what procedures are followed by the management to identify subsequent events. As we all know, the management, while preparing financial statements, they have to comply with accounting standards. And as per accounting standards, the management is having a responsibility to identify subsequent events. So before auditor, management is already having responsibility to identify subsequent events. So that's what the standard is saying. As an auditor, first you understand what procedures your client's management has followed for identifying subsequent events. Why? Because before the auditor, management is having the responsibility to find out the subsequent events. So first ask the management what procedures they have followed to identify subsequent events, and inquire management and where appropriate those charged with governance as to whether subsequent events have occurred. Directly go and ask the management themselves. Sir, did you find out any subsequent events? Ask them. First point, understand the procedures, what they are following. Second point, go and ask the management directly. Sir, did you identify any subsequent events? Third one, read the minutes of the meeting. Whatever board of directors meetings are there, shareholders meetings are there, whatever meetings which have taken place after the date of financial statements, after 31st of March, whatever meeting happened, be it shareholders meeting, be it board of directors meeting, be it those charged with governance meeting, read the minutes of all the meetings to find out whether any subsequent event was discussed. And read the entity's latest interim financial statements. If the recent quarterly financial statements are available, read it. And along with that, the auditor shall request the management to even provide written representations also. So auditor will perform these 5 audit procedures to identify whether there are any subsequent events or not. What are the 5 procedures? First, understand procedures which are followed by the management, then directly go and inquire with the management, read the minutes of whatever meetings happened after the date of financial statements, read the latest interim financial statements, and even ask written confirmation. So by doing all this, you will get to know whether there are any subsequent events or not. Now, after that, so as I have told in the objective, in case if you came to know about subsequent event after the date of auditor's report, you have to respond appropriately. No, now how to respond appropriately, that also this standard is saying. So whatever this standard is trying to convey here in the form of these lengthy paragraphs, that I will try to revise it in the form of one simple chart. Listen carefully, observe carefully. I will explain this slowly. Please pay attention. So what if auditor came to know about subsequent events after the date of auditor's report? What auditor should do? So now here we will divide the circumstances into broadly 2 categories. Case 1, auditor came to know about subsequent events after auditor's report, but before financial statements are issued. Auditor came to know about subsequent event after signing auditor's report. But by the time auditor signed the audit report, the financial statements are not yet issued. Financial statements did not reach any shareholder or outsider. The second case is, by the time auditor came to know about subsequent events after the financial statements are issued. That means by the time auditor came to know about subsequent events, financial statements are already issued to the common public. A shareholder is already having the copy of the financial statements. Clear? So 2 cases. In order to know auditor's responsibility, we have divided it into 2 circumstances. Auditor came to know about subsequent event after the date of auditor's report, but before financial statements are issued. That means by the time auditor came to know about subsequent event, financial statements did not reach shareholder or third party. That is case 1. Case 2, by the time auditor came to know about subsequent events, financial statements have already gone to the shareholder's hands. Which one is more complicated? Second case is more complicated. We'll come to that later. First, we will see what will happen in case 1. What if auditor came to know about subsequent event before financial statements are issued? So first thing what will happen is, the standard will say, first to go and discuss the matter with the management. Discuss with the management. I will go to the management and discuss with them. Sir, I found out a subsequent event. And as a part of that discussion with the management, we have to determine, whether financial statements need amendment. Why? Because subsequent events could be adjusting or not adjusting. So that's why you go and discuss with the management. As a part of that discussion, determine whether financial statements need amendment. If the financial statements need amendment, inquire how the management wants to address. Inquire how the management wants to address means inquire the management whether they are ready to amend the financial statements or not. So 3 steps: discuss with the management regarding subsequent event, determine whether financial statements need amendment as a part of that discussion, and inquire how the management wants to address. Inquire how the management wants to take this forward, whether they are ready to amend the financial statements or not ready. So here two things can happen. Management agreed to amend the financial statements. Management said, okay sir, we will amend the financial statements. If the management amends the financial statements, what I will do is, auditor will perform audit procedures to find out whether amendment is done properly or not. Why? Because we can't blindly believe whatever management is saying. So I will really check myself and confirm whether management did the amendment properly or not. And even I will try to obtain sufficient and appropriate audit evidence regarding that amendment. Management agreed, sir, we will amend the financial statements. Now what I will do, I will perform audit procedures to check whether the amendment happened properly or not. And even I will try to obtain sufficient and appropriate audit evidence regarding amendment. And is there any requirement to modify my opinion here? No. If I am satisfied that yes, management did the amendment properly, and the management I have obtained sufficient and appropriate audit evidence, management did the amendment perfectly fine, I will not give any modification. I will give unmodified opinion and give my audit report. This is very simple case. Now, the other case, that is where the complication will come. Management did not agree to amend. I am saying financial statements need amendment, but the management is saying no, we will not amend the financial statements. Now what will happen? So if the management did not agree to amend the financial statements, here also 2 cases will be there. Case 1, audit report not yet given to the management. You signed audit report, but you have not yet given it to the management. Audit report is still lying with you. You signed audit report today. You thought tomorrow you will give audit report to the management. But before that only you came to know about subsequent event. You told to the management. Management said we will not amend the financial statements. Since audit report is not yet given to you, since audit report is still with the auditor, you are in a favorable circumstance now. What you will do is cancel the audit report whatever you have with you. Give a new audit report which contains modified opinion. Why? Because management is not amending, no. So give the new audit report which contains a modified opinion. Whereas when it comes to case 2, which is audit report already given to the management. So you are no longer in possession to the audit report. You have already handed it over to management. So if audit report is already given to the management, first what you should do is instruct the management not to circulate the audit report. What auditor should do? Instruct management. What he should instruct? Instruct the management. Sir, please don't circulate the audit report till I make some amendments. So first give that instruction. Now give the audit report which contains a modified opinion. Why this step will not come here? Why? Because in the case 1, since audit report is not yet given to the management, you need not instruct them. But in case 2, since audit report is already given to the management, first you instruct them, don't circulate the audit report, then give the new audit report which contains a modified opinion, ask the management now to circulate it. But sometimes what will happen is management, without listening to your instructions, they might circulate the audit report. You told not to circulate, but management did not listen to you. They just like that circulated. Then what you will do? Then the standard is saying, in case without listening to your words, management, if they have already circulated the audit report, auditor should take appropriate action. Auditor should take appropriate action to stop reliance on auditor's report. What do you mean by stopping reliance on auditor's report? You should go and you should take some appropriate action to stop the people from believing the audit report. Sir, what could be appropriate action? So that could be a newspaper advertisement, media comment, whatever it is. You should take appropriate action to stop the people from believing audit report. When this will be taken? When even after your instruction also, management did not listen, still they have circulated the auditor's report. Then only. If they did not circulate, this step will not arise. Clear? So this is what auditor will do in case auditor came to know about subsequent event after auditor's report, but before financial statements are issued. Now let us come to the complicated scenario. What if auditor came to know about subsequent event, but by the time you came to know about subsequent event, financial statements are already issued. Financial statements have already gone to the public hands. Now what should happen? So now if you came to know about subsequent event, here also same steps. First, discuss the matter with the management. As a part of that discussion, determine whether financial statements need amendment and inquire how the management wants to address. Inquire whether management is ready to amend the financial statements or not. Before we proceed further, here one more step will come. Since the shareholders are already having the copy of audit report and financial statements, I will instruct the management to take appropriate action to stop reliance on the auditor's report. Since financial statements have already reached the hands of shareholders, I will go to the management and say, sir, financial statements have already reached shareholder, but now we have to amend the financial statements. So you take appropriate action to stop the people from believing auditor's report. Now, if the management takes the action, well and good. Sir, here also what could be appropriate action? Same. Giving a newspaper advertisement, media comment, sending emails, whatever it is. If managements take appropriate action to stop the reliance, well and good. Sir, what if the management did not take appropriate action? Then the standard says, auditor himself has to take appropriate action to stop the people from believing auditor's report. If management takes the appropriate action, well and good. If the management is not taking appropriate action, then the auditor himself has to take appropriate action. So whatever it is, either management or auditor, someone should take appropriate action to stop the people from believing audit report, whatever they have. Now, once again, after this, the matter will proceed further. Two circumstances could arise. Management agrees to amend the financial statements and management do not agree to amend the financial statements. Now, when the management agrees to amend the financial statements, well and good. Here also, I will perform audit procedures and obtain audit evidence whether amendment has been done properly or not. Now, these amended financial statements will be given to the shareholder once again. Now, my audit report also will be given once again. So, which opinion I will give here? Unmodified only. There is no need to modify. Why there is no need to modify? Why? Because management agreed to do the amendments and also I have obtained audit evidence that they have done the amendment properly. So, I will give unmodified. But here standard has told one more thing. If you observe carefully, now shareholders will get one more copy of financial statements and audit report. Shareholders have already got one copy of financial statements and audit report earlier. Why? Because financial statements are already issued. Now, after this amendment, financial statements and audit report will be circulated once again. Now, shareholder will have two financial statements in their hands. They might not be able to understand what is the difference between previously issued financial statements and the now given financial statements. So that's why what the standard will ask you to do is give unmodified opinion only, but in your new audit report, include a paragraph, either emphasis of matter or other matter paragraph you include it. And what I should mention in that emphasis or other matter paragraph, sir, what you should do in that paragraph is you draw users attention to the amendment. Nothing but you highlight what is the adjustment that has been done in the newly given financial statements, which is not there in the earlier financial statements. Nothing but whatever amendment has been done that you try to highlight in either emphasis of matter or other matter paragraph. Now, when it comes to the other case, what if the management do not agree to amend the financial statements? Obviously, we'll give audit report which contains modified opinion. We'll give modified opinion. Is there any requirement to use emphasis of matter, other matter? Not required. Why? Because when we give modified opinion, the reason anyhow we will explain in basis for modified opinion paragraph. So no need to use any emphasis or other matter paragraph. Here why we are using it? Because we are giving unmodified opinion and we thought it is necessary to draw users attention to the amendment. So that's why the standard is asking us to use emphasis or other matter, whereas in the other case, since we are giving modified opinion, anyhow we will explain the reason in basis for modified opinion. No need to make use of emphasis or other matter paragraph. That is what the auditor's responsibilities are in case if we came to know about subsequent event after auditor's report. So whatever I have tried to summarize in the form of the chart, that itself has been presented in a detailed descriptive format, which now if you refer, it will be very easy for you. Clear? So with this, we are successfully done with SA 560 also. Now we will talk about the next important standard, which is SA 570, which will be related to the going concern assumption. So let us try to revise now SA 570, which is talking about going concern. So as we all know, going concern is a fundamental accounting assumption. And what does the meaning of going concern assumption mean? So going concern assumption means it is basically an assumption that the entity will continue for the foreseeable future. For the coming 1 year, the entity will continue and there is no intention of the management to liquidate the company, or even the situations doesn't want the company to get liquidated. That means the company is having capacity, ability and intention to continue for the coming 1 year. That assumption we call it as going concern assumption, and the financial statements are prepared on the basis of that going concern assumption. And regarding this going concern assumption, which is used in the preparation of financial statements, auditor is having some responsibilities to fulfill, and those responsibilities are given under SA 570. So let us try to revise now what is this, or what are these auditors' responsibilities relating to going concern assumption. So before we talk about this auditor's responsibilities, first let me ask you one simple question. Who is primarily responsible for making an assessment related to going concern? It is whose primary responsibility to make assessment regarding going concern? So the primary responsibility to make an assessment regarding going concern always rests with management of the company. So the thing which I want to say here is the management of the company is primarily responsible for making an assessment regarding going concern. That is whether the entity will continue for the coming 1 year or not. That assessment is basically the responsibility of management of the company. And how the management will do that assessment, sir? On what basis they will decide whether entity will continue for the coming 1 year or not? On what basis they will decide? Will the intention of the management alone will be enough? No. The management's intention to continue alone will not be enough. In deciding whether going concern assumption is valid or not, the management will pay attention to various factors. Like those factors are going to be the degree of uncertainty associated with outcomes. Like, is the company going through any pending cases? Is the company facing any litigations which if the company has lost them, there will be chances of company getting closed down. So like that, they will pay attention to these kind of uncertain events like pending litigations. Even they will pay attention to what is the size of the entity currently, how complex the entity is. Even they will pay attention to nature and condition of the business. What is the current condition of the business? Along with that, even they will try to find out, are there any external factors which have an impact on going concern? Like for example, changes in the laws or regulations. Sometimes changes in the laws and regulations can affect the going concern of the company. So whatever it is, the management is primarily responsible for making an assessment regarding going concern. And when making that assessment, the management will pay attention to these many factors, and then they will decide whether they have a ability to continue in the coming 1 year or not. Now, for what duration the management has to make an assessment? The management shall make an assessment for the coming 12 months. The management should make an assessment for 12 months. So if the management is doing an assessment for less than 12 months, you should not accept. As an auditor, you should insist the management. So in order to decide whether going concern is valid or not, you must compulsorily do the assessment for 12 months, insist the management and ask them to do the assessment for the coming 12 months. If at all, if you want the management to make an assessment for more than 1 year, you can ask it. But in any case, don't compromise if the management is doing an assessment for less than 12 months. So management will do this analysis and they will decide whether going concern assumption is valid or not. If the going concern assumption is valid, the company will value assets and liabilities in such a manner that they will be able to realize it in the ordinary course of business. If the going concern assumption is valid, the management will show assets and liabilities as if they will be able to realize in the ordinary course of business, which means that if the going concern assumption is valid, the entity will value fixed assets at historical cost that they can follow. On the other hand, if the management decided that going concern assumption is invalid, then what management has to do is they have to prepare their financial statements on liquidation basis, or even we can call it as realizable value basis, which means if the management has decided that going concern assumption is invalid, which means entity will not be able to continue for the coming 1 year, they cannot value fixed assets at historical cost. They have to value all the assets and liabilities at realizable value, and the differential should be taken to the statement of P&L either as a loss or gain. Understood? On the other hand, if the going concern assumption is valid, the company can value their fixed asset at historical cost and current assets and liabilities on a going concern basis. But the moment going concern assumption becomes invalid, all the assets, all the liabilities will be valued on realizable value and the differentials will be taken to the statement of P&L. So this much impact will be there on the financial statements as a part of that going concern assumption. So whatever it is, management will do assessment and on that basis they will prepare financial statements. Now what is auditor's responsibility? So let us see. So the responsibilities of auditor are, the objectives of the auditor are to obtain sufficient and appropriate audit evidence regarding and conclude on the appropriateness of management's use of going concern basis of accounting. So if you observe carefully, the standard is not asking auditor to make an assessment regarding going concern. No, the standard doesn't say that. But in fact, what standard says is whatever assumption management has made regarding going concern, whether it is valid or not, that auditor need to obtain sufficient and appropriate audit evidence. So if I put it in simple language, if the management is saying going concern assumption is valid, as an auditor, I need to obtain audit evidence whether really going concern assumption is valid or not. If the management is saying going concern assumption is invalid, I need to obtain audit evidence whether really going concern assumption is invalid. So I need to obtain audit evidence, whatever assessment management has made regarding going concern, whether that is valid or not, I need to obtain audit evidence. And as we all know, how I will obtain audit evidence? I will obtain audit evidence by performing audit procedures. Now, and second objective, to conclude on the basis of evidence obtained whether material uncertainty exists related to events or conditions that may cast a significant doubt on entity's ability to continue as going concern. Which means on the basis of whatever evidence that you have gathered, you need to analyze, is there any material uncertainty? Sir, what do you mean by material uncertainty? Material uncertainty means whether entity will continue or will not continue. That is depending on some circumstances which are beyond the control of the management. So what do you mean by material uncertainty? Whether entity will continue or entity will not continue, that depends on some circumstances which are beyond the control of management or auditor. So find out on the basis of evidence whether there is any such material uncertainty. And finally, whatever findings are there, you have to report them. Whatever findings you have, that you need to report them appropriately in accordance with standards. So three objectives: obtain audit evidence regarding management's use of going concern assumption, and determine on the basis of audit evidence whether any material uncertainty is existing, and whatever your findings are there, you have to report them as per the requirements of this standard. Now, so the standard is saying try to obtain sufficient and appropriate audit evidence, and as I have mentioned, we will obtain audit evidence only by performing audit procedures. And the audit procedures to be performed by the auditor, they are divided into two categories. One is risk assessment procedures, and the other one, as you could see here, further audit procedures. Nothing but in the risk assessment procedure, the standard will ask the auditor to find out whether there are any events or conditions that could cast a doubt on entity's ability to continue as a going concern. So what they are saying, in the risk assessment procedures, we need to find out, is the company going through any events or conditions which can create a doubt regarding entity's ability to continue as a going concern. So what are that events or conditions, sir? First, let me take you through what are that events or conditions that could create a doubt to the auditor that company might be going through problem of going concern. So those events I have given it here, the standard itself has identified those events or conditions which could cast a significant doubt on entity's ability to continue as a going concern. Nothing but, which means if auditor came to know about these events or conditions, immediately you should get a doubt. Okay, the company might have a problem regarding going concern. So that events have been divided under three categories: financial indicators, then we have operating indicators, and finally we have other indicators. Let us see a few examples of that: financial indicators, operating indicators, or other indicators. If I talk about financial indicators, the company is always having net liability position. That is, its liabilities are more than its assets. Definitely, this will create a doubt to the auditor regarding going concern. And also, fixed term borrowings are approaching maturity without any repayment. The company has taken a loan in the past, that due date is coming in the next 1 year, but the company doesn't have money to pay. Obviously, this will create a doubt regarding going concern. Or the company is relying on short term borrowings to finance their long term requirements. So like that, some financial indicators are given. Similarly, some operating indicators like management's intention to liquidate. The management themselves don't want to continue. When I go and ask the management, sir, do you have intention to continue the business in the coming year? They are saying, no, we don't have any intention. Or the management has lost the key management in the organization. Some key person in the organization has left the organization. Loss of major market, you are losing your market share, you are losing your key customers, you are losing your franchises license. This also created doubt regarding going concern. Similarly, we have some other indicators like non-compliance with capital or regulatory requirements. Like banks are required to comply with CRR SLR ratio. What will happen if they don't comply? RBI will pass an order to close the bank. So when you came to know your client did not comply with statutory requirements, will that create a doubt regarding going concern or not? Yes. Or pending cases against the company, which if successful will result in claims that entity will be unable to satisfy, which means company is going through such bad cases, such big litigations. If the company loses that case, the consequences will be so huge that they will not be able to fulfill. Or some changes in the laws or regulations. So like this, there will be some financial indicators, operating indicators, and other indicators. Now the auditor, by performing risk assessment procedures, he should identify whether any of this financial, operating, or other indicators exist. That is what auditor will do in the risk assessment procedures. Like if I take you through the terminology, when performing risk assessment procedures, the auditor shall consider whether any events or conditions exist that may cast a doubt on entity's ability to continue as a going concern. Nothing but I need to find out whether any of the financial, operating, or other indicator exist, which I have taken through now. Sir, how auditor will find out, sir, whether any events are there or not? Simply what he will say is, go and inquire with the management. What the standard is saying, go and inquire with the management and find out whether any financial, operating, or other indicators exist. That's what they say here. In doing so, the auditor shall determine whether management made an assessment regarding going concern. I told you, management is primarily responsible for making assessment regarding going concern, he will go to the management and ask first, sir, did you make an assessment regarding going concern? Yes, assessment has been performed by the management. Then the auditor will sit with the management and discuss, dear management, did you identify any of financial, operating or other indicators? If yes, how you are planning to address them? So as an auditor, you need to find out whether any financial, operating or other indicators exist, and how you can do it. If first go and ask the management whether they have done assessment regarding going concern. Yes, if they have done it, ask them directly, dear management, did you find out many financial, operating or other indicator? If yes, how you are planning to address it? What if the management has not yet made an assessment? The management did not make an assessment regarding going concern yet. Then what auditor shall do is, the auditor shall discuss with the management the basis for intended use of going concern basis of accounting and inquire the management why they have not yet done the assessment yet. If the management has not yet made an assessment regarding going concern, ask them, sir, without making assessment, how you are able to decide going concern is valid, and inquire them because of what reasons they have not yet done the assessment. So whatever it is, by simply doing inquiry of the management, find out whether any of the financial, operating or other indicators exist. If you don't find any financial, operating or other indicator, your responsibility will come to an end with risk assessment procedure only. But in case if you find out any financial, operating or other indicator, then you will perform further audit procedures. So what will be that further audit procedures? Like, observe the terminology here. If events, conditions have been identified, that means if you find out any financial, operating or other indicator, then you will perform extra procedures. What are they? Like, if the management has not yet made the assessment, first I will go and ask the management to make the assessment regarding going concern first. Similarly, I will try to sit with the management and ask them what are the plans for their future and check how far those plans are feasible, and also analyze their cash flow forecast. What do you mean by cash flow forecast? Their cash flow budgets for the coming 1 year. So I will try to ask the management, sir, did you prepare projection of cash flows for the coming 1 year? If yes, give it to me. Analyze that cash flows of the future, whether receipts are more than expenses or not. Check it once. And also check whether any additional information is available from the time management made an assessment, and even ask written representation and extra procedures like analyze the cash flow of the company, profit of the company, read the latest interim financial statements, read the loan agreements to know whether they have made any default in the loan agreements, read the minutes of the meeting, inquire with the legal counsel what pending cases are there. So all these things you will do, provided if you find out any financial, operating or other indicator. If you do not find any financial, operating or other indicator, I will end my audit procedures with risk assessment procedures only. So whatever it is, by performing this audit procedures, you will have findings now. And how to report that findings, impact on auditor's opinion, that is the most important thing in the standard. So how the auditor's findings will have an impact on auditor's opinion, this we will try to summarize in the form of a chart. Please pay attention. So impact on auditor's opinion as per SA 570. So I will typically divide the circumstances into three categories. Number one, going concern is appropriate. Auditor performed audit procedures and I came to know that yes, going concern is valid, no issue with the going concern assumption. What opinion I will give? If I obtained audit evidence going concern is all perfectly fine, everything is valid, I will obviously give unmodified opinion. There is no need to give any kind of modification. Second one, going concern is inappropriate. Sometimes I perform audit procedures and I conclude that the entity's going concern is invalid. The entity will not be able to continue in the coming 1 year. So I obtained audit evidence and concluded that going concern is inappropriate. That means entity will not continue for the coming 1 year. Now, how this will impact your auditor's opinion? So here directly we can't say modification, etc. Here the standard will ask us to check one more thing before we decide on the opinion. So when the going concern is inappropriate, first we should check whether adequate disclosure is given in financial statements by the management, or there is no adequate disclosure given in the financial statements. When going concern is inappropriate, that means when management has when the auditor has decided that entity will not continue for the coming 1 year, what auditor will check is, he will check whether adequate disclosure given in financial statements or adequate disclosure not given in financial statements. So what do you mean by adequate disclosure given in financial statements? Which means that going concern has become invalid. Management did not deny it. Management agreed to that, and they have valued all their assets and liabilities at realizable value. They did not value assets at historical cost. They have valued all the assets and liabilities at realizable value. Differential component has also been taken to statement of P&L. That is what the meaning of adequate disclosure given. So if the management has given adequate disclosure, you tell me, are the financial statements giving true and fair view or are they misleading? The financial statements are giving true and fair view only. Why? Because management did not hide anything. So we will give what? Unmodified opinion only. Whereas, if the management did not give adequate disclosure in the financial statements, which means what? Auditor obtained audit evidence that going concern is invalid. But still, management is continuing to prepare the financial statements on going concern basis, which means management is still valuing their fixed assets at historical cost only. Even after auditor got evidence that going concern is invalid, management is not agreeing. They are still saying, no, sir, we will still value our assets at historical cost only. Now, what auditor will do? The standard has directly told, go and give adverse opinion. Directly adverse. No need to check for any other options. Directly give adverse opinion. Why? Because you have a evidence, and if the management tries to do something wrong with the going concern assumption, the impact will not be just material. It is going to be material and pervasive. Directly give adverse opinion. No need to check for any other kind of modification. Clear? So this is what the standard has told. So if the going concern is inappropriate, this is what will happen. So two circumstances, very easy. Going concern is appropriate, going concern is inappropriate. Now let us come to the third scenario which could be possible here. The third scenario which could be possible here is auditor has decided that there is a material uncertainty relating to going concern. There is a what? Material uncertainty relating to going concern, which means whether entity will be able to continue for the coming 1 year or not, it is completely uncertain. No one is sure about it. Whether it will continue in the coming 1 year or not, it depends on some circumstances over which management doesn't have control. Even auditor is also not able to decide whether entity will continue in the coming 1 year or not. So if there is a material uncertainty relating to going concern, most important thing here, what will happen is here also the standard will ask the auditor to check whether there is adequate disclosure given in financial statements or no adequate disclosure given in the financial statements. Adequate disclosure given in financial statements, which means there is a material uncertainty. Management did not hide anything from the shareholder. In the notes to accounts, clearly they have told so and so uncertainty we are facing, so and so crisis we are having, whether we will continue for the coming 1 year or not. That is depending on some circumstances which are beyond our control. That management, without hiding anything, clearly they have told this information in the notes to accounts. Now you tell me, if there is an adequate disclosure in the financial statements, should the auditor give unmodified opinion or modified opinion? First of all, are the financial statements misleading here? Not misleading here. They are not at all misleading. Since they are not at all misleading, why? Because management has given enough of disclosure. Auditor will give unmodified opinion here. But the standard will say one more thing here. In addition to unmodified opinion, don't you think this material uncertainty which has already been disclosed in the financial statements, it is fundamental to users' understanding of the financial statements? Yes, it is fundamental to users' understanding of financial statements. Don't you think this information should be highlighted to the shareholder? Yes. Where it will be highlighted, sir? The standard is asking the auditor to use one dedicated paragraph with the heading material uncertainty relating to going concern. Like this, one paragraph with this heading shall be used in the auditor's report, and in that paragraph the auditor should give reference where the user can go and read that information regarding uncertainty. Understood? So if adequate disclosure has been given regarding material uncertainty, the financial statements are giving true and fair view. Management did not hide anything. So auditor will give what? Unmodified opinion only. But since this matter is very important to shareholders understanding, what the standard is specifically saying, what SA 570 is specifically saying, it is asking auditor to use one extra paragraph in his audit report with the heading material uncertainty relating to going concern and bring it to the user's attention. That's all. Sir, what if there is no adequate disclosure? If there is no adequate disclosure, straightforward, we will give modified opinion. Which kind of modified opinion, sir? Either qualified opinion or adverse opinion will be given. If the effect of material uncertainty is only material but not pervasive, qualified opinion. If the effect of material uncertainty is material and also pervasive, then adverse opinion. So auditor will give modified opinion if no adequate disclosure has been given in the financial statements. Here also, is there any requirement to use additional paragraph with the title material uncertainty relating to going concern? No. Why? Because if the auditor is giving modified opinion, the reason will be anyhow explained in basis for modified opinion paragraph. Where the reason will be explained, the reason will be anyhow explained in the basis for modified opinion paragraph. So that's why there is no requirement of using any extra paragraph. Just to give the modified opinion and explain the reason in basis for modified opinion. No requirement of any additional paragraph here. So this is how the auditor's opinion will be impacted based on observations whatever he has regarding going concern. So whatever I have explained here, everything has been given here in the descriptive format, that you can understand it and remember it now very easily, keeping this chart handy. Clear? So this is what regarding going concern. With this 7 standards we have successfully revised. We are left with only 3 standards pending for our revision. One is SA 220, then we have SA 550, and even we have SA 710. These 3 standards are not that important from the examination perspective, but still I will not leave them. I will not ignore them. I will try to revise the key concepts from this 220, 550, 710, or I will try to give overview of all this 3 standards now. So we will take up now SA 550 for revision. So what does SA 550 deal about? SA 550 is a standard which is exclusively talking about related parties or related party transactions. So as we all know, when it comes to related party transactions, there are so many accounting requirements as per accounting standards, and even there are so many disclosure and presentation requirements as per Companies Act 2013. Why? Because related parties are such a kind of transactions where there is a huge scope for manipulation. So that's why even ICAI has also given a dedicated standard which will help the auditor to verify related party transactions. So let us try to understand what is this SA 550 saying about the auditor's responsibilities relating to related party transactions. As I have told, I will give a quick overview of this entire standard. So let us now have a look at the standard, what they are trying to explain, or what they are expecting us from this standard. So if I go to SA 550, first thing in the standard, they have defined the term related party. Here, the ICA has played it very safe. So when it comes to definition of related party, what they have told is a party that is either a related party as defined in the applicable financial reporting framework. So what they have told, in case if the applicable financial reporting framework has defined the term related party, that only will come under related party. Like in case if you are conducting audit of a company, the Companies Act, that is applicable financial reporting framework, Companies Act, in the Companies Act, they have clearly defined the term related party. They have given a very huge chunk of relationships which will be covered under related party definition. So even standard is also saying that since applicable financial reporting framework, in our example, since Companies Act has already defined the term related party, that definition will be applicable. Whereas if the applicable financial reporting frameworks provides minimal or no related party requirements, that means in case if the applicable financial reporting framework is not defining the term related party, or they are defining the term but it is a very minimal definition, then the below mentioned definition will be applicable. Hope you are able to get the point. So what the standard is saying, if the applicable financial reporting framework has already defined the term related party, we will follow. In case if the applicable financial reporting framework provides very minimal or no definition of related party, then the standard is giving one definition. What definition? Very simply, 3 things they will say. Any other entity which is having control over your client's entity, or other entity over which your client is having control, or your entity and other entity both are under common control. That's it. That's what they have simply defined. So like if you see a person or other entity that has control or influence over the reporting entity, nothing but if your client is X Limited, if some entity is controlling or influencing your client, that will come under related party. Second point, Another entity over which reporting entity has control. Assume your client is X Limited. If X Limited is controlling or influencing somebody, that will come under related party. Or your entity, your client entity and other entity, if they are under common control, both are having some common control. How that common control can come? That common control can come either by way of common controlling ownership, that is a common ownership, or both the entities owners are some closely held family members, or both are under common key management. When I say common key management, there are same board of directors, same CEO, same CFO, same key managerial person, etc. And when this definition will become applicable, this definition will become applicable in case if the applicable financial reporting framework provides very minimal or no definition to the term related party. However, one important statement for true or false statements: the entities which are under common control by a state, here what they mean is government. If there are two or more entities which are under common control of some government, they will not be considered related unless they engage in some significant transactions to share resources or with one another. So what is the thing they're trying to say is, when it comes to government, if some entities are under common control of the government, like Indian Oil Corporation and Bharat Petroleum, both are under common control of the government, still they will not be considered as related unless both are engaging in some similar transactions or they are sharing resources, then only they will be considered related. This is exception for the definition. Clear everyone? So this is how the term related party has been defined. Now, nature of related parties, how the related party transactions will occur. Here simply they will try to say one thing: when the related party transaction is also in the normal course of business, like with the related party also same terms and conditions, arm's length price, everything is happening in the normal course of business. Like a outsider, if the transactions are happening with the related party, then they may carry no higher risk of material misstatement. When everything is as per normal terms and conditions, when everything is in the ordinary course of business, when the transaction is happening at arm's length price, there is generally no need to suspect, there will be no higher risk of material misstatement. However, in some circumstances, related party transactions may carry higher risk of material misstatement. When everything is as per normal terms and conditions, no need to suspect. But in some cases, in some cases you have to become cautious. Why? Because in some cases related party transactions carry high risk of material misstatement. When so? When related parties are operating through a extensive and complex range of relationships. The relationship is very complex. See, if the client is having direct subsidiary, easy to identify related party. But sometimes what will happen is they will create a chain of group companies. Like one company will be there, they will create subsidiary company. That subsidiary will create another subsidiary. That subsidiary will have an associate. That associate will be a partner in some LLP. So like this, so many things will happen. See, when there is this long chain of relationship, there is a high risk of material misstatement. When the relationship is straightforward, they carry less risk of material misstatement. On the other hand, when they have a complex chain of relationships, then they carry high risk of material misstatement. Not just that, whatever information systems which your client is using for identifying related party transactions, if that information system is ineffective, whatever accounting software which your client is using for identifying and reporting related party transactions, if that accounting software is ineffective, then also related party transactions carry high risk of material misstatement. And even related party transactions, sometimes they may not be conducted under normal market terms and conditions, especially when the transactions are happening without any consideration. So in these circumstances, the risk of material misstatement is very high. When nothing like this is happening, when everything is as per normal terms and conditions, they carry lower risk of material misstatement. So this is about nature of related party transactions. Now, what are auditors' responsibilities? In one word, if I have to end it, the summary of all these points, what they try to say is, there are so many accounting and disclosure requirements when it comes to related party transactions. Be that accounting and disclosure requirements are as per accounting standards, be they are as per schedule 3, whatever it is, as per applicable financial reporting framework, there will be so many accounting and disclosure requirements. Now, as an auditor, what is your responsibility is to perform audit procedures and make sure that all that accounting and disclosure requirements are properly given in the financial statements. That's all your responsibility. So there are so many accounting and disclosure requirements as per applicable financial reporting framework, be it schedule 3, be it accounting standards, whatever it is. There are so many reporting requirements, accounting and disclosure requirements. Whether the client has completely given all that accounting and disclosure requirements or not, checking that is auditor's responsibility by performing audit procedures. And finally, you have to make sure that financial statements are giving true and fair view and they are not misleading, especially by related party transactions. That is what your responsibility. And even one more thing they will try to say here, having a related party transaction is even a fraud risk factor also. Why it is a fraud risk factor? Why? Because when the client is having related party, it is very easy to manipulate. It is very easy to collude with the others. See, a third party might not act according to your instructions, but related party always acts according to your instructions, so it is a fraud risk factor. So that's why, as an auditor, you have to be very cautious while verifying related party transactions. Sometimes that will help you in identifying fraud risk factors. Sometimes that can indicate you the existence of the fraud also. And apart from that, as we all know, because of inherent limitations of audit, no matter how effectively you do the audit, there is always a unavoidable risk that your opinion can go wrong. And if you remember, the risk of inherent limitations is very high when it comes to related party transactions. Normally, anyhow, we have inherent limitations. But when it comes to related party transactions, the effect of inherent limitations is even higher. That means the chances of auditor's opinion going wrong because of misstatements in the related party transactions is much higher. Why in the related party transactions the severity of the limitations is very high? Why? Because sometimes management themselves may not be aware of existence of all the related parties. And as I have mentioned, related party relationships will provide greater opportunity. They provide very good opportunity for collusion. As I mentioned earlier, the client cannot, you cannot make a third party to behave according to your instructions, but related party will always act according to the instructions of your client. So because of these reasons, when it comes to related party transactions, the impact of the impact of inherent limitations is also very high. But one thing we can do to do our work effectively, what is that one simple step is, by maintaining an attitude of professional skepticism, we can keep the risk at a very low level. We can avoid our liability by maintaining professional skepticism. So that's what auditors responsibilities are. So if I summarize, first I need to check accounting and disclosure requirements as per applicable financial reporting framework. Be cautious, related party transactions will help you to identify fraud risk factors also. And here inherent limitations impact will be very higher. So in order to avoid that, we need to maintain professional skepticism. Don't accept anything blindly, have a questioning mind. Then finally, how the auditor can come to know which is a related party, which is not a related party. So how the auditor can verify existence of related party. So what the standard says is, they will ask you to refer some documents like verify the entity's income tax returns and even check the information which has been supplied to regulatory authorities like ROC. Check the shareholder register to know who is having significant shareholding in the company. Even check the statement of conflicts which are submitted by management and board of directors. Check the entity's investment register. This will help you to know who is the client's subsidiary, associate, etc. Check the contracts and agreements which have taken place with the key management or top level management. Check whether any contracts are there which are not in the ordinary course of business. Check the life insurance policies which have obtained by your client. Why? Because that will let you know who are key people in the organization. And similarly, check the internal auditors report and also check the documents which are filed with authorities like SEBI, etc. So if you refer all these documents, you will get an idea who is related party, who is not a related party. That's all SA 550 says. So we have seen meaning of related party and also what is the nature of related party transaction, what is auditor's responsibility, and how the auditor can verify the existence of a related party. So this is what SA 550 talks about. Now we are left with two more standards. Now we will start SA 220. Very simple standard. Quickly we will try to wind it up. So SA 220 is the standard which is talking about quality control. So let me take you there. Yes. So SA 220 is the standard which is going to guide us about how to control quality whenever you are doing audit of the financial statements. So as we all know, we chartered accountants do so many audit assignments, and it is very important in all that audit assignments to maintain the quality. Why? Because when we don't do the audit in a qualitative manner, not just one or two persons will be affected, so many stakeholders financial interest will be at risk. So be it banker, be it shareholder, be it creditors, be it debtors, so many people are going to use your audit report, and they will form the decisions on the basis of your audit report. So if you compromise on the quality of the audit, that wrong audit report will affect the interest of so many stakeholders. So it is very important to maintain the quality control in the audit of financial statements. And SA 220 is trying to help us out how to maintain quality in the audit assignments which we are doing. So that's what, even if you read the objective, you will get an idea. The objective of the auditor is to implement some quality control procedures at the engagement level that will give the auditor reasonable assurance that whatever audit that you have done, that is complying with the professional standards and also legal and regulatory requirements. That means whatever audit you have done, that is as per standards on audit, and also that is as per laws and regulations, and whatever auditor's report has been given, that is appropriate. So the conclusion here is this standard is going to give you some guidance by which you will get the confidence that yes, whatever audit I have done it as per the standards on audit, and whatever report I have given, that is appropriate. That confidence you should have. That is what the meaning of doing the work in a qualitative manner. Why? Because you will get that confidence only when you have done it in a qualitative manner. So that's what the entire objective of the standard. Now, how that quality can be ensured in the audit? So what SA 220 says is, in order to maintain quality in the audit assignments which we are doing, there should be some policies and procedures which auditors should follow. And that policies and procedures are required to be followed in 6 areas. So what does the standard say? In order to maintain quality in the audit assignments, there should be some policies and procedures which which as an auditor you have to follow. And those policies and procedures are required to be followed in how many areas? In 6 areas you need to follow some policies and procedures. So what are that 6 areas, sir, in which I need to follow some policies and procedures? As you could see here, number 1, leadership responsibility. Number 2, ethical requirements relating to an audit of financial statements. Number 3, acceptance and continuation of client relationship. Number 4, human resources. Number 5, engagement, performance, and number 6, monitoring. So once again, I am repeating, there are 6 areas over which there should be policies and procedures. What are that 6 areas? Number 1, leadership responsibilities. Number 2, ethical requirements. Number 3, acceptance and continuation of client relationship. Number 4, human resources. Number 5, engagement, performance, and number 6 is monitoring. So if you follow some policies and procedures in these 6 areas, yes, the auditor can ensure that there is quality in the audit assignments which he is doing. So let us try to understand in each of this area what kind of policies should be there. First, talking about leadership responsibility. If as an auditor you want to make sure that there is a quality in the audit assignments, someone should come forward and take that leadership responsibility. Sir, who should come forward and take that leadership responsibility? SA 220 says that engagement partner himself should come forward and take the leadership responsibility. Now, first of all, who is engagement partner? So the act says that engagement partner is a partner, like as you could see, engagement partner is a partner or other person in the firm who must be a member of Institute of Chartered Accountants of India, and he should be in full-time practice, and he will be held responsible for the engagement and also its performance and the report which is issued on behalf of the firm. If I put it in simple terms, if an audit firm is appointed, whoever partner signs the audit report, that person will be called as engagement partner. As simple as that. So that's what they are trying to give it in a technical definition. They are saying something that that person should be a partner or other person in the firm. He should be a member of ICI. He should be in full-time practice and he will be held responsible. How he becomes responsible? By signing the audit report. So whoever is signing the audit report, that person will be simply called as engagement partner. So SA 220 says that someone should come forward and take the leadership responsibility. Who should be that someone? Engagement partner should be that someone who should come forward and take the leadership responsibility. Now, just if you come forward and say, if I am engagement partner, if I come forward and say, I will take the leadership responsibility, by saying just like that, you are not fulfilling your responsibility. Then how to fulfill that leadership responsibility, sir? That's what they say here. If you want to fulfill that leadership responsibility, if you want to make sure that your engagement team is doing the work in a qualitative manner, just saying out loud that you are a leader alone will not be enough. Either by way of your actions or by way of your messages, you should try to highlight some information to your rest of the team members. Being a leader, what I should do, either by way of my actions, by the way I behave, or by way of my messages, I should make sure that my engagement team members are aware of some information. What information? I should highlight that how important it is to perform the work that complies with professional standards. I have to let my staff know how important it is to do the audit as per standards on audit and laws and regulations, and also how important it is to comply with firm's quality control policies and procedures, how important it is to give the audit report that is appropriate. Let them know what will happen if you give the wrong audit report, and also create such an environment in your audit firm that if any of your engagement team member has concerns, you should be able to come forward and get them clear. You should not have a fear that if I go and ask the question to the engagement partner, how he will behave. Such a bad environment you should not create. Being a leader, you should create such a favorable environment that if anybody is having concerns, they should be able to openly come and communicate with you. And in addition to that, you have to let them know the fact that quality is very essential in performing the audit. So being a leader as an engagement partner, you need to do these things either by way of your messages or by way of your actions. You should highlight how important it is to do the audit as per standards on audit, how important it is to comply with the policies and procedures, create a favorable environment where people will come and ask their concerns, and also tell them how important it is to maintain the quality, and also how important it is to give appropriate audit report. So these kind of policies you should have it in the first area, leadership responsibility. Coming to the second one, ethical requirements relating to audit. This ethical requirements, we know it already. We have revised it as a part of nature, objective and scope of audit. 5 ethical requirements will be there. What are 5 ethical requirements? Integrity, objectivity, confidentiality, professional competence, professional behavior, and due care. That's all, no? So these are 5 ethical requirements. What are they? Integrity, objectivity, confidentiality, professional judgment, professional behavior, professional competence, and due care. So these 5 ethical requirements, if you have, then audit will be done in a qualitative manner. Next, third point, acceptance and continuation of client relationship. This also we have covered it in nature, objective, and scope of audit. So before accepting and continuing client relationship, there are 4 factors which auditor needs to consider. What are the 4 factors? Check the integrity of the management, check whether you will be able to comply with ethical requirements, check whether you have enough of engagement team, whether you are competent enough to complete the audit, and even you should consider significant matters which have arisen during the course of previous audit. So that's why at the time of accepting and continuing client relationship, then only you have to consider these 4 factors which we covered in nature, objective, and scope of audit. What are the 4 factors which we need to consider? Number 1, checking integrity of the management, compliance with ethical requirements, competence of the engagement team members, and finally significant matters which have arisen during the course of previous audits. Now fourth area over which you need to have policies and procedures, which is going to be human resources. Why? Because if human resources means nothing but your staff. If you have good staff, if you have capable staff, if you have competent staff, if you have knowledgeable staff, if you have hardworking staff, then only audit will happen in a qualitative manner. If you don't have good staff, if you are having incompetent people, if not experienced people, not committed people, if you don't have a strong team, you will not be able to do the audit in a qualitative manner. So that's why in your policies and procedures, you need to have those policies and procedures when it comes to your staff also. Sir, what kind of policies I need to have regarding my staff? So like at the time of recruitment, select only those people who are ready to develop their skills and knowledge. Don't give importance for recommendations. Select only those people who are competent enough. And periodically do the performance evaluation. Once in a while, check how effectively they are performing. Capabilities, try to increase their capabilities, try to increase their competence, provide them scope for career development, create some sessions for them. And if you find someone is working very hard, give them enough of give them promotion, give them enough of compensation, and even try to meet their personal needs also. Why? Because employees' personal conditions will have an impact on their professional life also. So if possible, try to meet their personal needs. So try to have these kind of policies and procedures when it comes to your staff. Then your staff become more competent, then audit will happen in a qualitative manner. So this is what regarding the 4th area. Now talking about the 5th area, engagement performance. So when the engagement is getting actually performed, then also you need to have some policies and procedures. Like what, sir? Like when you go for audit, don't directly ask the engagement team members to jump into the audit. Give them proper briefing, at least give a brief introduction what they are supposed to do, etc. Why? Because all the engagement team members might not have equal knowledge. Sometimes there could be new staff also. So that's why before audit is getting started, give them a brief about the entire audit, and also let them know how to comply with engagement standards. Don't just say go and comply with standards. Let them know how to comply with the standards also, and do proper supervision of their work. Give them proper training, give them proper coaching. That means when they are actually doing the work, if they are getting stuck somewhere, go and help them out. And don't blindly believe whatever your engagement team members are doing. Even review their work also. Review of work of engagement team members is also highly important. And finally, give them proper instructions to maintain enough of documentation, and give them instructions that to keep themselves updated with all the policies and procedures whatever have been implemented. So like this, whenever you are actually performing the engagement, these kind of policies should be there, like giving proper briefing to your staff, let them know how to comply with engagement standards. Wherever they are getting stuck, supervise them, give them training, give them coaching, review the work whatever they are doing, tell them how important it is to maintain the documentation, and make them updated with all the policies and procedures. So these policies you should have when it comes to engagement performance. Then finally, the last one, we have monitoring. See, just implementing policies and procedures alone will not be enough. Even we need to do periodical inspection of assignments whatever we have completed, and check whether in that assignments which are already completed, whether the policies and procedures are complied or not. Why? Because just if you take a printout of all the policies and attach it on the walls and cabins, it will not be enough. I need to make sure that whatever policies and procedures which I have designed, whether they are getting really implemented or not, I want to know. How you will come to know? By monitoring, by reviewing. That's what the monitoring stage. Now, what is the purpose of monitoring? Why you have to monitor? Why I have to monitor? Because if I do the monitoring, then only I will come to know whatever assignments I have done till now, whether they are done as per professional standards, whatever quality control system which I have designed, whether it is really getting implemented, whether my staff is complying with those policies, whatever reports I have given till now, whether they are appropriate, and in case if any changes are needed to my policies and procedures, I can do the follow up by the concerned person and make that changes to my policies and procedures. Nothing but you will find out whether you have to make any changes to the existing policies and procedures. So since monitoring will have these many benefits, that's why just implementing policies and procedures alone will not be enough. Periodically, I have to verify or monitor how far these policies and procedures are getting implemented. Is there any requirement to update, delete, or change them? So like this, if you follow these policies and procedures in these 6 different areas, then rest assured there will be quality in the audit assignments. Clear? So that is what the objective of the standard, and this is what the standard is trying to provide the guidance. Now we are left with only one more standard, which is SA 710. Without any delay further, let us try to revise that SA 710 also. So what does SA 710 deal about? So let me take you to that standard. So as I've already mentioned, you can download this material, whatever I am displaying here, and how to download that material, I will give the explanation in the description given below. So from there, you can download this material and have access to it. So whenever you are watching this video, keep that material handy so that you will be able to memorize the content even more. So let us now complete this last standards revision. So as you could see, SA 710 and SA 710, the title itself says it is talking about comparative information and corresponding figures and comparative financial statements. So first of all, if you observe carefully, in the title of the standard, three terms are used. Number one, comparative information. Number two, corresponding figures. Number three, comparative financial statements. So like this, three terms are used in the title of the standard itself. Number one, comparative information. Number two, corresponding figures. And number three, comparative financial statements. First, we will understand what is the meaning of these three terms. Talking about comparative information, Comparative information means nothing but whatever information which will be presented in addition to current year's financial statements. Whatever information which is presented in addition to current year's information. If I put it in simple terms, prior year's information, one or more prior year's information which is presented in addition to current year's financial information, that we call it as comparative information. So what they're trying to say is, assume you have downloaded financial statements of company for the financial year 21-22. Now, when you have a look at the balance sheet, you will be able to find three columns there. Number one, particulars will be there. Then there will be a column dedicated for 21-22 financial year. And there will be even one more column which is related to 2021 financial year also. So this is current year's information. But in addition to current year's information, even prior year's information also will be presented. That prior year's information which is getting presented, we call it as comparative information. And this comparative information can be presented for 1 year also, can be presented even for more than 1 year also. It depends on applicable financial reporting framework. In India, the applicable financial reporting framework is expecting you to present only last 1 year's information. That way we are presenting only 1 year information. In some countries, their respective applicable financial reporting framework says to present 2 years of information. Then 2 years of information like even 1920 also will be added. This both years information will be called as comparative information. So whatever it is, like if you see the definition here, the amounts and disclosures which are included in the financial statements in respect of one or more prior periods, that too in accordance with applicable financial reporting framework, we call it as comparative information. And this comparative information will be of two types. One is corresponding figures and the other one is comparative financial statements. Now, what is this corresponding figures? What is this comparative financial statements? As I have told, both are actually types of comparative information. So, corresponding figures refers to, like if you read the definition, it is a kind of comparative information which is included as an integral part of the current period financial statements, and they are intended to be read only in relation, intended to be read only in relation to amounts and other disclosures relating to the current period. Sir, what does that mean, sir? So corresponding figures means that kind of comparative information which has to be read only in relation to current year's figures. So what is corresponding figures? It refers to such a kind of comparative information which has to be read only in relation. Like for example, if I take 21-22 financial statements, along with that 2021's information is presented. Now this information has to be read only in relation to 21-22 year. You can't read only 2021 information from this financial statements. This column is presented so that you can read it only in relation to last year's information. You can't read only 2021 information from the current year's financial statements. This column is presented only to read in comparison. Only for comparison it has been given. You can't read it separately from this financial statements. And generally in the case of corresponding figures, what will happen is when we are doing audit, in the case of corresponding figures, our opinion refers only to current year. It will not relate to prior years. If you are conducting audit of corresponding figures, whenever we are expressing opinion, our opinion will be related only to current year. Our opinion has nothing to do with the comparative information. In which case? In the case of corresponding figures. So once again I am repeating, corresponding refers to that kind of comparative information which is given to be read only in relation to current year's information, and in that case our opinion refers only to current year. We have nothing to do with the prior year's information. Whereas if it is a case of comparative financial statements, if we are conducting audit of comparative financial statements, our opinion refers to all periods covered in the financial statements. Our opinion refers to what? All periods covered in the financial statements. Like if I am assume this is a case of comparative financial statements, assume I am conducting audit which is a comparative financial statements. If I am doing audit of 21-22, And in the financial statements, even last year's information is presented. Now if it is a case of comparative information, my opinion will not just relate to 21-22, even I will give my opinion on 2021 also, in which case comparative financial statements. If it is a case of corresponding figures, my opinion refers only to if it is a case of corresponding figures, my opinion relate to only current year. I have nothing to do with the prior years. Sir, now which one has to be followed, sir? Should I follow corresponding figures or should I follow comparative financial information, comparative financial statements? It all depends on applicable financial reporting framework. In India, the applicable financial reporting framework is expecting you to follow only corresponding figures. That's what we generally do. In case if you are conducting audit of any company for the financial year 21-22, we will express opinion only on 21-22. Even in the financial statements, 2021's information is presented. We have nothing to do this. Our opinion has nothing to do with this year. So that's why in India we follow what? Corresponding figures. Our opinion refers only to current year. But as I have told, there are some countries which can expect the auditors to even follow comparative financial statements. Some countries will expect you to express opinion not just on the current year, even the prior year's information, whatever is presented on that also you have to express your opinion. But luckily in India, we have only corresponding figures. We need to express opinion only on current year's information. So we understood the definition of comparative information. We understood the definition of what is corresponding figures and comparative financial statements. Both are actually types of comparative information only. Now, what is objective of SS 710? With what objective SS 710 has been provided? The objective is very clear here. As an auditor, you need to obtain sufficient and appropriate audit evidence about whether comparative information, whatever it is presented, whether that is as per applicable financial reporting framework or not. So what is my first objective as per SS 710? Whatever comparative information, be it corresponding figures or be it comparative financial statements, whatever comparative information that is presented in the financial statements, whether it is as per applicable financial reporting framework or not, I need to obtain sufficient appropriate audit evidence, and whatever findings are there, I need to report them in accordance with the standard. And how to report them? That's what we are going to see it in the rest of the standard. Now, there are some common audit procedures which you need to perform regarding comparative information. When I say comparative information, that could be corresponding figures also, that could be comparative financial statements also. Whatever may be the approach, for all the comparative information, there are some common audit procedures. Like I told you, comparative information will be of two types, no? One is corresponding figures, other one is comparative financial statements. Now they are saying audit procedures regarding comparative information, they are saying. That means these audit procedures are going to be common. Be it corresponding figures, be it comparative financial statements, these audit procedures which we are going to read are common for all comparative information. Sir, what are that common audit procedures, sir? Very simple. First one, I need to check whatever information is there, whatever comparative information is there, whether that is as per applicable financial reporting framework or not. If the applicable financial reporting framework is asking you to present only one prior year's information, I will check only 1 year's information is presented or not. If the applicable financial reporting framework is asking the client to prepare last 3 years of information, I will check whether last 3 years of information is presented or not. So whatever may be the approach, be it corresponding figures, be it comparative financial statements, the first common audit procedure is I will check whether comparative information is presented as per applicable financial reporting framework. And then other common audit procedures, whether the comparative information agrees with amounts and other disclosures presented in prior period. Whatever comparative information is there, whether that is matching with the last year's financial statements or not, that I need to check. Be it corresponding figures, be it comparative financial statements. So what they are trying to say is, if I am conducting audit of 21-22 year, corresponding figures will be, comparative information will be what? 2021. Now I need to check whatever comparative information which is presented here. For last year there will be balance sheet, no? Like last year, if you take last year, there will be 2021 and 1920. So I need to check current year's comparative information is matching with financial statements of the last year or not. That I need to check. And similarly, whatever accounting policies are there which are reflected in the comparative information, whether they are consistently applied or not, if at all there is any valid reason for deviation, whether that change has been properly accounted for and disclosed or not. So some other standard should start making sense here, which is going to be SA 510. In SA 510 also we have seen something similar to it. So whether the accounting policies are consistently applied without any valid reason, they should not be changed. If at all there is a change in any accounting policy, I need to check that whether it has been properly accounted for and disclosed or not. The same thing they will try to say here. And when you become when it comes to your notice that there is a material misstatement in the comparative information, you need to perform some additional audit procedures also. And finally, as an auditor, you need to obtain written representations from the management regarding comparative information. So four common audit procedures they are saying: check whether comparative information is presented as per applicable financial reporting framework, check whether it is matching with the prior periods, check whether accounting policies are consistently applied, and if at all if you find any material misstatement, perform additional audit procedures and even ask written representations from the management. Now, when it comes to auditors reporting requirements, first we will talk about corresponding figures. As I have mentioned, in normal circumstances, if it is a case of corresponding figures, your opinion shall refer only to current year. You have nothing to do with the prior period's information. However, there are some exceptions to this rule. The general rule is, if it is a case of corresponding figures, your opinion shall refer only to current year. Your opinion has nothing to do with corresponding years, corresponding figures. That's what the general rule no. Now I am saying there is an exception. That means in some cases, even though it is a corresponding figure, still our opinion will refer to prior periods. So in what case, even though it is a corresponding figures, our opinion will refer to prior period? They will give three exceptions. So what are that three exceptions where even though it is a corresponding figure, our opinion will refer to last year? Number one, last year's financial statements are audited. Prior period financial statements are audited. And because of what, when the last year's financial statements contain modified opinion. Which opinion? Last year's financial statements contain modified opinion. When I say modified, it could be qualified, adverse, disclaimer, whatever it is. So prior periods, last year, take for example, I am doing 21-22's audit. Last year is what? 2021. So last year's financial statements were audited in the last year. And last year's audit report contains modified opinion. When I say modified opinion, it could be qualified, adverse, disclaimer. And because of whatever reason the last year auditor gave modified opinion, that reason is not yet rectified in the current year. It is still relevant in the current year. It is still relevant in current year. So some reason is there because of which last year auditor gave modified opinion. That reason is not yet rectified in the current year. That reason is still material for the current year. Now for the current year, what auditor will do? For the current year, auditor will give modified opinion. So for the current year also, what the auditor will do modified opinion. Why? Because of whatever reason last year auditor gave modified opinion, that reason is not yet rectified. That reason is still relevant in the current year. So that's why current year auditor also will give modified. And when the auditor gives modified opinion, he will use the basis for modified opinion paragraph. No, in the basis for modified opinion, what auditor will say? If I am an auditor, I will say last year there is a misstatement which is material, which is not yet rectified in the current year. That's why I'm giving modified opinion. So if you observe carefully in your audit report, you are taking reference to last year's figures. What I will say in the basis for modified opinion paragraph, I will say, sir, for the current year, I'm giving modified opinion. Why? Because there is a misstatement which is there in the last year. The same misstatement is there in the current year also. Generally, in normal circumstances, in your audit report, if it is a case of corresponding figures, you should not refer to prior years, no. But here you are taking the name of last year. You are saying in the basis for modified opinion, there is a misstatement in the last year. So whatever it is, you have taken the reference to the last year, no. Which generally should not happen in the case of corresponding figures. So that's why it is an exception. Generally, if it is a case of corresponding figures, nowhere in our audit report we will take reference to last year's information. But here you are taking reference to last year's information. Where? In the basis for modified opinion paragraph. Why? This is an exception? No. That's why. So once again, I am telling one exception where even though it is a corresponding figures, we will take reference to last year. When the last year's financial statements were audited, last year auditor gave modified opinion, and because of whatever reason last year auditor gave modified opinion, that modification is still relevant in the current year, then the current year auditor will give modified opinion, but still in the basis for opinion paragraph he will take reference to prior years, which should not happen in the case of corresponding figures, but since it is an exception, that's why we are saying here it will include reference to prior year. This is case 1. Second exception, what is the second exception is, last year, prior year financial statements were audited, and in the previous year the auditor gave modified opinion. Sorry, that is first case. Prior year's financial statements were audited and the last year auditor gave unmodified opinion. He told last year financial statements are giving true and fair view. And after giving unmodified opinion, while you are doing current year audit, you found a misstatement. You found a material misstatement, which is not relating to current year, which is actually relating to previous year. Last year's financial statements were audited. Guys, this standard is a bit complicated. If you understood the concept at least once, then only this revision will make sense. So if this revision is not making sense, that means you don't have conceptual clarity about this standard. If you don't have conceptual clarity about this standard, don't worry about it. I will upload a dedicated video explaining about this SA 710. Matter is bit complex. If you have already listened to the class once, then you will definitely understand. If you are not understanding, don't worry. I will upload a separate video for concept explaining this SA 710 in a detailed manner. After that, if you watch this, then it will start making sense. So anyhow, let us come back to the discussion. Prior year financial statements were audited. Last year auditor gave unmodified opinion, and in the current year the auditor found a misstatement which is relating to previous year. Since it is a misstatement relating to previous year, what management should have done? Management should have shown it as a prior period item. Yes or no? What management should have done? Management should have shown it as a prior period item. But management is not doing it. In the current year, I found a misstatement, and that misstatement is relating to previous year. Management should have shown it as a prior period item, but the management is not showing it as a prior period item. Now in the current year, what I will do is I will give modified opinion. Here also, in the basis for opinion paragraph, what reason you will say? I will say there is a misstatement which is happened in the previous year. Once again, the rule is violated. If you observe here, it is a corresponding figure, but still in your audit report, you are giving reference to previous year, which should not happen. No, this is also one exception. Understood? What is this exception? Once again, I am saying prior year financial statements were audited. Last year auditor gave unmodified opinion, but in the current year auditor found a misstatement which is relating to previous year, and the management is not ready to show it as a prior period item. I will give modified opinion, but in the basis for opinion paragraph, once again I will take reference to previous year. I will say misstatement is related to previous year, which I generally should not do. If it is a case of corresponding figures, I have nothing to do with last year's information, but since it is an exception, I am doing it. One more case where I will mention prior years in my audit report, even though it is a corresponding figures, is when I conducted the last year's financial statements. I'm doing current year's audit, but I came to know that prior years were unaudited. Last year is unaudited. If the prior year's financial statements are unaudited, then what current year's auditor should do is, in the other matter paragraph, where in the other matter paragraph of the auditor's report, the auditor should mention that last year's financial statements are unaudited. What auditor should do? If the prior year's financial statements are unaudited, the current year auditor, in which paragraph? In other matter paragraph, he should mention that the last year's financial statements are unaudited. But whatever it is, even in other matter paragraph, you are taking the name of last year's financial statements. No, you are saying in your audit report last year's financial statements are audited. That's all. You have taken reference to last year, which we should not do in the case of corresponding figures. But since it is an exception, we are doing it. Clear, everybody? So three cases generally in the case of corresponding figures, our opinion shall not refer to prior periods. And I told you three cases which are exceptions. That means even though it is a corresponding figures, in these three cases in our audit report, we will take reference to last year. So that is what very important content from this standard. That's why I have spent some time on it. With this understanding, if you read it, you will be able to understand it. Now coming to the last point, audit reporting regarding comparative financial statements. This is relatively very easy. So what is the simple thing here is, since it is a case of comparative financial statements, our opinion will refer to every year. So if I am doing audit of 21-22, last year's information 2021 is also presented, and it is a case of comparative financial statements. My opinion will be on 21-22 also. My opinion I will give it on 2021 also. So here there is nothing specific here to discuss. So in case of comparative financial statements, auditor's opinion will refer to all the periods. But the standards say one more thing. If the opinion which you are giving on comparative financial statements and if the last year's auditor's report, if both are not matching, then that differences you have to explain in other matter paragraph. So what I mean to say here is, when I am conducting audit of 21-22, if it is a case of comparative financial statements, I will give opinion on 2021 also. Assume that in the current year, while doing audit of 21-22 year, I gave modified opinion for both the years. But last year also audit would have happened. What will be last year's financial statements 2021, 1920? But in the last year, I gave unmodified. Same year, as a part of last year's audit, I gave unmodified opinion. For the same year, as a part of current year's audit, I gave modified opinion as a forming part of comparative financial statements. So both are same years, but in both the cases, I have given different opinion. Current year, as a part of comparative financial statements, I am giving modified opinion. But in the last year, for the same year, for the last year, for the same financial year, I have given unmodified opinion. So whatever reasons are there for the difference in that opinion, that differences are required to be explained in other matter paragraph. So that's what we have given it here in the second point. When reporting on prior periods financial statements in connection with the current period's audit, if the auditor's opinion on such prior period financial statements differs from the opinion of the auditor expressed, then the auditor shall explain the reasons where in other matter paragraph. So these are some key points from comparative financial statements. See, this standard is not actually suitable for revision, so that's why I'm revising the key terms. So this standards you need to have very much conceptual clarity, so that's why I'm telling I will upload a separate video about it. So this is what regarding SA 710. So we understood what is comparative information. We understood what is comparative financial statements, corresponding figures, their reporting requirements, common audit procedures, everything we have understood. So guys, this is what the revision regarding standards on audit. So we have spent somewhere around 3 hours of time, and we have covered lot of standards, 10 standards almost we have covered. So which is actually a very wider coverage. So hope this revision will help you for sure. So this is what I thought of revising from the chapter standards on auditing, and trust me, if you are thorough with this 10 standards whatever I have covered, there is a possibility in your favor to get minimum 12 marks in the examination. Clear everyone? So this is what regarding standards on auditing revision. Hope this revision has helped you out, and for more such information please subscribe to my YouTube channel to stay updated and also to make your auditing concepts very clear. Thank you guys. Bye.